So today is Wednesday, July 19th. Welcome to week 2 of our class. Before we get started today on content, just wanted to ask if there was any just general questions about anything so far. Questions or comments?
Professor, are we going to go over the conversion homework?
Yes, we are.
Okay, I was going to have questions on that, but sounds good.
Yes, and I'm actually about to post a solution here in just a second. So while I'm posting the solution, again, any other questions about anything? Any trouble accessing the YouTube videos, being able to do the assignments? I know you guys some of you are working in pairs. Any issues submitting in your paired groups? I'm sure both people's names were on the assignment. Okay, that's good. All right, so in the files section, under week 2, there is a file that I'm about to post up there, which is the solution to the conversion assignment. Let's go ahead and upload it right now. It is called conversion solution final.xls. Actually, sorry, conversion solution. Let's see. Actually, yeah, final.xls. And let's upload. Those. All right, should be there. What I'm about to go over, I don't normally do, which is normally when I go over the solution to the conversion assignment, I don't give formulas. The formulas for all of the sheets, I just give numbers, because in other versions of this class, I don't want, well, basically what happened a few years ago is a student created a solver, which basically if you just put in any statements, it would auto create the 4 statements for you based on the solution that I posted. And that's beyond an honor code violation. It's kind of unethical, but he was profiting off of it. But anyways, so I've stopped giving out the solution with the actual formulas in it. I am making an exception for this class. So that's the good news. So I've actually put that file there, but I would just ask that, you don't share this or post it on a public website where others get access to the solution with the formulas. And there are 2 students who have asked for an extension on this conversion assignment, and they're going to get a separate conversion assignment. So they're not going to actually convert these statements. They're going to have to convert other statements because we're going to cover the conversion solution here in just a minute. So in any event, so that file is there. The other file that's relevant to tonight is in the file section under lecture notes. There's a lecture note 2 that we will be covering a little bit later today. Matter of fact, I'm going to start with lecture note 2 because I want to make sure that this was partially what was in the video and in the book, but I want to reinforce a couple of key concepts that are in lecture note 2 as we get started. So lecture note 2. Share file. skip. We'll come back and talk about this. Sorry, wrong lecture note 2. Second try. All right. So to highlight a couple of things that you did, and just kind of an important way to understand both what we're going to do in the future weeks, as well as what you are going to be working on for the next week of the class. But a lot of valuation, and this is the McKinsey-based approach, is based on Modigliani-Miller. And the graphic that is on the screen is a simple representation of Modigliani-Miller, right? And the general idea is that when we do valuation, what I'm going to teach you as an additional step that other people often skip over is that we are going to separate out operating activities from non-operating activities. Because typically when accountants publish financial statements, they just put them all out there. They don't care. It's not the way that accounting is set up under FASB rules. So since we're taking an economic / cash flow view of the firm, what we need to do is we need to do 2 things. One, we need to translate accounting statements back to a more cash flow orientation. And 2, when we do that, we're going to be mapping it to Modigliani-Miller, which is the graphic that's here on the screen. And what it says is a company's worth the sum of its future cash flows. And it's going to basically have 2 types of cash flows. One is the operating cash flows, and 2 are the non-operating cash flows. And because we're going to use the concept of net present value, if we present value those cash flows to today, then we can add them together. And that will be called enterprise value, or EV for short, right? And it is that value, the enterprise value, that is available to the debt and equity holders of the firm. As a matter of fact, valuation is going to be relatively straightforward because once we know the enterprise value, we pay off all the debt, subtract all the, basically the interest-bearing liabilities, and then we pay off the non-common shareholders. And then what's left is the common equity value divided by share price. Okay. So the good news is that once we kind of put the financial statements into this format, it gives us 2 benefits. One is kind of a clean, better understanding of what's going on with the firm. And since this is the advanced class, that's going to be very important. And then the other piece is it will give us a much cleaner valuation. Matter of fact, the other people that do it not this way kind of end up at the same place. They kind of skip this intermediate step, and it actually makes their evaluations a little bit more difficult, sometimes not always complete. And what you'll find is this extra work will actually benefit you in getting out of a cleaner view of what's going on with the firm, but it will also help the valuations be a little bit cleaner. So that's really the process that I'm going to teach you, which is McKinsey's process, which is based on what they talk about the valuation. So the other kind of key topic that I want to make sure everybody understands is the 3-step process that we're going through, which is different than the 2-step process that most people go through. And the first step is we start out with the accounting statements, income statements, and balance sheets. And then we figure out what's operating, what's non-operating, what is a debt equivalent, which is anything that's interest bearing, and anything that's an equity equivalent, right, which is something that's a return to the shareholders. And basically we rearrange those statements into those 4 Modigliani-Miller buckets, and they will have terminology which is unique to McKinsey, which is basically the operating income statement. It will get you what's called NOPLAT, and the operating or the non-operating income will be looked at separately. Operating NOPLAT plus non-operating income gets us something called rearranged statements TII, total income available to investors. And it is that income that is then distributable to the debt and the equity holders. So essentially the debt being the interest and the equity being the net income. Okay, and that's part of what you just did. Okay, and then the other piece is we're going to rearrange the balance sheet into the operating items, operating assets, operating liabilities, net, that's invested capital. Also there's operating invested capital. We'll take all the non-operating assets, non-operating liabilities, we'll net them. It'll be non-operating capital. Take your operating invested capital, non-operating capital, add them together, that's total funds invested. And that will be financed by interest-bearing debt and equity. And those two sides will equal each other. Okay? And that was really the first two things that you did in your conversion. And then the third statement is cash flow. And what's important about cash flow is cash flow is the difference between the cash generated by the income statement less the cash reinvested in the balance sheet. Okay. And we basically follow that process 4 times. When we do that in an operating basis, no plat minus change in invested capital, that's free cash flow. Okay. Operating income minus change in non-operating investments, non-operating cash flow. Free cash flow plus non-operating cash flow, CFI. That's the cash you generate from non-operating and operating activities combined that you can pay to your investors. That will be equal to the payments that you make to your debt holders, interest or principal, and the payment you make to the shareholders, dividend or share repurchase. So you can kind of go across. You can also go up and down, which is one of the key points of these statements. And then that's where we're going to go in 2 weeks when we do valuation, which is forecast your free cash flows. That's the operating value of the firm. Forecast your non-operating cash flows. That's your non-operating value. Add the two together. That's your enterprise value. Pay off all the debt. That's what's left is residual or equity value. The enterprise value is the cash that's available to the debt of the equity holders. So this graphic is your blueprint to what you did and conceptually what you're going to need to continue to do. Okay. And what's most important about this is just you kind of understand what it's telling you and what we're trying to accomplish. So I'm going to pause here. I know you watched the video, you did the assignment. Any questions about this that need clarification? Or hopefully it's relatively straightforward and it follows a logical flow.
Professor, is there any reason other than like obviously we arrive at sort of the economic profit in a way that's relatively easy to comprehend and explain? Is there other value in terms of breaking it down like this? Like these are the variables and the levers that we want to look at when comparing companies against each other, or is this more a case of like being really clear and thorough in terms of how we get to our end evaluation?
It's actually a little bit of both. So hold on, let me log into Bloomberg here while we're talking. And I'll give you an example, which hopefully will actually take a second to log into Bloomberg. So hold off on the example, but I'll at least talk through the example. So let's say you're valuing a company like Apple, right? And the whole point is that ROIC is a proxy for free cash flow. Okay, so to oversimplify this without seeing the data, Apple's ROIC last year calculated where you don't separate these out and you just look at the overall return on the business was approximately 50%. Okay, so conceptually, here's the idea. 50% ROIC means you're generating 50 cents of cash per dollar of investment. Okay, so when you value Apple, then the question is, what does that 50 cents look like for the next 30 years? Keeping it simple, because after 30 years, when you discount something, it becomes almost meaningless. So tell me how much cash per year, per dollar of investment Apple is going to generate, starting with 50 today. That's why we use the growing perpetuity. And if it's growing, like maybe it'll grow 5% a year. So start with 50 cents, grow to 5 cents a year, figure out what that cash is, discount it today. That's your value of Apple. Okay. That'll be the value that we would use to value, pay off the debt, and then you get the equity value. That's what you would learn in any class, right? And if you follow that approach, you'd misunderstand Apple's value. That's the problem. What I just told you conceptually works, and you would misvalue Apple. Okay. And the reason why is because that ROIC, which I'm finally being able to log into Bloomberg now, is the value of both the operating part of Apple and the non-operating part of Apple that's averaged together. Right. And the problem is, now that you know what a non-operating asset is, Apple's got almost $200 billion of cash sitting around earning 3 or 4% interest that they haven't yet distributed to their shareholders. They're not really using for their business because they make so much money selling iPhones and Macs. They don't really need to borrow any money. So basically, they make most of this money, by the way, outside the US, and they haven't wanted to repatriate the US because they avoid paying the 21% tax rate in the US by keeping the money outside the US. So they don't have to pay it until the money actually crosses international lines. So a lot of Apple's profits, which are overseas, they haven't paid full taxes on, and they don't intend to pay full taxes on because they don't want to repatriate the funds. So they just keep a bunch of money in the bank. And ironically, in order to pay out their dividends, what they do is they borrow debt in the US at an almost AAA credit rating, they're AA+, and at very, very low rates. And the collateral is $200 billion of cash sitting overseas. So they borrow the debt in the US really, really cheaply, okay, even today, 2-3%. And what they do is they then take that money and they use it to buy back the stock and to pay the dividends. So you're like, why would they do this? And the answer is for tax reasons, because they're going to take a 21% haircut on moving the money back into the US. So rather than do this, they just pile the cash outside the US that's just sitting there, and they basically borrow against it in the US to return the money to the shareholders, right? And in most, versions of the world, people like, this doesn't make any sense until tax laws comes into play, right? But nonetheless, that's what they do. A lot of companies try to do this. So long story short, how do we value Apple? Well, when you value Apple, and again, I will show it to you here on the screen. This is Bloomberg. Just easy to find some data. Here's Apple. And here are their historical financial statements. And right now, I rounded off. In 2022, it's 169 billion. So I overstated their cash balance by about $30 billion. Okay, so it's 169. It was 190. They paid out some. They got $169 billion cash. Most of this is sitting outside the US. Okay, now I'm using actual data. So here's the point. Okay. Apple's ROIC, which is the profit off the income statement after tax divided by the investment on the balance sheet. Now, if you don't distinguish debt and equity, you get ROIC. And Apple's ROIC last year, ROIC as of the latest year, not the latest filing, which would tie to that $160 billion worth of cash, 48.78%. I rounded off, I called it 50. Okay. So here's the point. When Apple sells the next iPhone, I'm forecasting Apple, right? They're going to sell a bunch of iPhones next year, right? We're going to say that they're going to make another 50% ROIC, because that's the ROIC that they make today, which they made for multiple years, been around 50%. Okay. So that's the point. They're going to generate 50 cents of cash, free cash flow, essentially, for every dollar invested. And that's the way that we're going to value Apple. Right. But here's the point. Does Apple need to borrow another $169 billion worth of cash to sell more iPhones? No, they do not. But if we value Apple at 50% ROIC, that's exactly what we're doing. We're assuming that all of the assets on their balance sheet are their return on their investment, because most people don't distinguish. The return on the investment, which includes all this cash, is 48%. So when they sell their next product, they're going to make 48%. That's the way most people would value Apple. And they're going to misvalue Apple because they don't need to borrow the $169 billion worth of cash. That's non-operating. if you look at the operating ROIC for Apple,
Professor, quick question about that. Wouldn't they need to borrow the money if they're trying to execute their tax avoidance strategy?
they would.
They don't necessarily need to, but that's
They
their strategy to save money for the
But we're looking at
shareholders.
that separately. That has nothing to do with the value of the enterprise. It has the value to debt the equity, how I distribute and chop up the enterprise value. But it doesn't change the enterprise value at all, because that's the whole point of the Modigliani-Miller model. Debt and equity have no impact on operating value. They don't change how many iPhones they sell because they have debt or they don't have any debt. So that's valued separately, okay? And you can optimize debt and equity. I'm not saying you can't do that. What I'm telling you is it doesn't change operating value. And it won't change the non-operating value. And that's the whole point of understanding Modigliani-Miller. But here's the real important point. When Apple actually sells products on an operating basis, they make a 600% ROIC. So Apple has two businesses. They have a business selling products that make 600%. And they basically have a savings account, which makes 4%. When you average the two together, you know what you get? 48. But if I'm valuing Apple, the point is they're not going to grow that cash balance for reasons that were just talked about, because they're going to do their best to try and distribute it because they don't really need it. They're not going to grow this cash balance the same rate that they're going to grow their business selling iPhones. So that's where people will misunderstand Apple's value, and they'll underestimate value, because as good as that 48% looks, when they actually sell products, they don't make 48%, they make 600%. And the more products they sell, the more cash that they're going to generate at a rate of $6 of profit for every dollar of investment, not 48 cents a profit for every dollar investment, because that's the problem with using the average when a company has a lot of non-operating assets. And you can see it on their actual balance sheet. So I'm going to go back to their actual balance sheet, because I want you to think about this. If we look at Apple's actual balance sheet last year, 2022, okay, what are they really using as investment? They're using accounts receivable, that's operating, $28 billion. They have inventory, $5 billion, because all their inventory is done by Foxconn, the Chinese firm. They've convinced Foxconn to hire hundreds of thousands of people to buy a bunch of assets and to build all their product and take all of that asset risk. Apple takes none of it. They don't take any possession of those iPhones until they leave China for the US. So they got about 5 days worth of inventory hanging around the US. But go order a product now at apple.com, build it to order, and you're going to see a 2-week delay, because Foxconn's going to build it somewhere near Shanghai, and they're going to ship it to you on a plane, and it'll get here in 2 weeks. And they're not going to pay for it until it lands in the US, because they've convinced the Chinese to take all that asset risk. So they got 5 billion of inventory, 28 billion accounts receivable, rounding off 33. They have accounts payable of 64 billion, which means negative working capital of negative 30 billion. Because that's all the money that's non-interest bearing that they owe their suppliers for products that they're going to pay them in 30 days on, that they got paid by you by a credit card in 2 days. So they got negative 30 billion of working capital. And then their total property, plant, equipment is $52 billion. Because most of the property, plant, equipment sitting in China, owned by Foxconn, not by Apple. So yeah, they got a nice spaceship in Cupertino. They got a few stores. They got the stuff inside the stores. 52 billion of PP&E. Subtract 30 billion of accounts payable from negative working capital, and they are financing about $22 billion of invested capital. And on a $22 billion investment, last year, EBIT was $119 billion. 20 billion of investment generates $120 billion worth of profit. That's a 600% ROIC. That's Apple. And that's the point. They're not going to borrow another $160 billion to invest in plant or buildings or inventories to sell those iPhones are going to have about 20 odd billion dollars working in their business to make their products on a continued basis. As long as they keep outsourcing to China, they've been doing it for 15 years. So that's Apple. And that's the genius, Tim Cook. He set up the most successful supply chain in the history of the world. And Apple has rode that all the way to becoming a $3 trillion company. And that's why they're a $3 trillion company. People misunderstand this because that's the point. Their core operating business has very little capital and churns out almost 400 billion in sales and 120 billion in profit with $20 billion of investment, 600% ROIC. Yes, I will value separately the fact that they have all this cash sitting in the bank, 23 billion in short-term cash, another 53 billion in miscellaneous longer-term investments, 120 billion of marketable securities. Like, okay, I'll value that at cash. So what's Apple? Apple's $169 billion worth of cash plus $2.8 trillion of operating value. That's Apple's stock price. That's what Modigliani Miller helps you understand that the average finance person would miss. Because when the average finance person would value Apple, you know what they would do? They'd leave the $160 billion worth of cash in the investment. So they would value Apple as if they had 20 billion of capital plus 160 billion of cash, and they would say they would have $280 billion worth of investment. Still a great return. So they would generate $120 billion worth of profit on a $280 billion investment. And that's the 50% that everybody else would value them on. And I'm telling you, if you repeated that, you would not understand what's going on with Apple. And that's where most people miss. That's why you're in the advanced class. And this is why we're doing what we're doing. And I know you feel that you probably hated that last assignment, right? Because it's not the way you were taught to think in accounting. It's not the way you're taught to think in most finance classes because they simplify it, because they just leave the debt and equity lumped together. And that does not get you true valuations. Questions? Did I help answer that question that you're asking? Were you able to follow some of the data? This is being recorded, so you can go back and look at some of these screens. But more importantly, working on this stuff in the next couple of weeks, we value companies.
I think it makes sense the way that you describe it. I think the part that's hard to get your head around is like, if they're not paying out dividends, like, why does that not like reduce the expected return? Like that, surely that has some kind of impact on like what you're getting.
It goes back to the free cash flow. The theoretical value of the firm. Let's assume you have no non-operating assets. Okay. So this is back to what you guys just did in your homework assignment. Go back here. Okay. Your operating value of the firm right here is all your free cash flow. Assume you have no non-operating value, so your free cash flow becomes your enterprise value. Okay. Notice it is that enterprise value that pays back the debt and the equity. So that's the point. How you pay out the free cash flow and the enterprise value doesn't change the free cash flow. It doesn't change the enterprise value. It just changed the percentage that goes to the debt holders and the percentage that goes to the shareholders. Okay. So that's the point. Free cash flow is the theoretical payout rate of the firm. It's what can be paid out. And then you make a choice. Do I pay it all out or do I put in the bank? If I pay it all out, it goes to the debt and the equity holders. If I don't pay it all out and it's truly free cash flow, I now have a non-operating asset that I didn't have before called excess cash. And then my firm will be any future free cash flows plus the cash that I didn't pay out that I should have. And that's the cash that I can eventually pay out to my debt and equity holders. So you can think of excess cash as cash waiting to be paid out. Now, companies at some point could decide, well, hey, I want to raid my rainy day fund and then use it for operating activities. Well, at that point, it's not excess cash anymore. Now we've turned it into property, plant, equipment, or inventory, or receivables. Now it's part of our operating invested capital. But if I don't need it for operating invested capital, then at any point in time, I could go buy back some stock. And I could use my excess cash to do it. So when people look at a company, the excess cash that's truly excess that came from the free cash flow, that's included in the value. But it's just at the value of the cash, because it's not going to grow. At best, it's NPV 0. Because if you're investing it in treasury bills, that's an NPV 0 proposition. You're not going to make 12% on that. So you're going to make 3 or 4%, and the cost of capital is 3 or 4%. So it's going to be NPV 0. So the value of the cash is the value of the cash. That's the biggest non-operating assets that most firms have, is when they just put cash in the bank, because it doesn't earn 12%. And that's the misnomer, because that's the problem with the other side of this equation. Because if you assume Apple keeps making 50% in the future, the average of the two, you're assuming that they're making 50% on that cash balance. And that's not going to happen. Nobody's going to make 50% on cash unless you're burning that off. And then you're just committing fraud. So that's the point. Does this make sense? Questions?
Yeah, that makes sense. I think I'd probably ask that, were they to invest that cash in a way that does generate greater returns, then obviously then they're going to have to pay tax on it. So there's no point for them
Absolutely.
to actually do that. Yeah.
And then it's not non-operating anymore. And then we would add it to their operating investment. And then we would treat it like any other operating investment. That's why it's important conceptually to kind of get an understanding of what's going on. So this is another reason, which leads into the homework assignment you're not going to like, that you're going to have to do for today. Because it's both cool, but I'm going to make, since you're the advanced class, it's going to be a little bit of a pain in the ass to do. But here's the point. We're going to look at operating values, right? We're going to ignore the non-operating values, because the non-operating values are not drivers of the firm's value. They have value, but at best they're NPV 0. Right? And that's one of the assumptions that we make in valuation, that non-operating values are NPV 0 going forward for 95% of the companies you look at. And the reason why is because if they don't know what they're doing in the non-operating activities, they're probably not going to earn above average rates of return. And most non-operating assets are just cash sitting in a bank. So I'm not going to earn high rates of return in non-operating investments. Right? The only exception is financial services firm. Meaning, let's say that I am BlackRock and I own passive investments in other companies. Well, I can earn a great return on that, but we're not valuing banks here. We're valuing operating companies. And so therefore, in operating companies, non-operating assets are NPV 0. So the real driver of value is operating cash flow. So we need a better look at what those free cash flows are. That's why we need an operating ROIC, and it takes some work to create it, which is why you had to do the conversions. So the biggest part of the conversion, and that's why I call it labeling, figuring out what's operating. What in the balance sheet is operating? What are the assets that are operating? What are the liabilities that are operating? What is the income that's operating? And how much taxes do I pay on that operating income? Those are the core things that we really have to understand to get a cleaner view of the value of the operations of the companies. And the only way we do that is the accountants don't put it in that view. They don't care about what I'm talking about. Is we have to basically do some work on statements. And again, that was the premise of the homework assignment you did for this week. Again, I'll pause. That was a lot, short period of time, but hopefully it helped clarify a few things. By the way, let's say the company I work with is called Parker Hannifin. Let's say you're valuing Parker Hannifin, which is a multinational maker of valves and parts, mostly for the aerospace industry. And you're looking at the supplier to bigger companies like Boeing and Airbus, et cetera. And you look at their traditional ROIC, which last year was an average of the operating and non-operating combined, which is this number. And then you look at their operating ROIC, where you go through the process that we're about to go through in this class, and you just strip out the operating capital and the operating profits. You'll notice that the operating ROIC is not all that different than the average ROIC. It's not like Apple. So if I'm valuing Parker Hannifin, the work that we're doing, not as big a deal. Because the company doesn't have a lot of non-operating capital and the operating and non-operating are pretty close together, then you're not going to have the issues that I described. So sometimes you'll be okay and sometimes you won't. But I'm going to teach you how to do it, what I'll call it, a more improved way, regardless of the company. So you will understand that. Because the other thing you'll notice about Parker Hannifin is that if their operating performance is 13 and the average of the operating and non-operating is 17, they actually made some money in non-operating items last year. Okay. And the reason they did it is because they had some sales, one-time sales. Okay. And so you start digging in their financials, you're like, well, this has nothing to do with them selling products to customers. That's actually the 17%. So I might actually overvalue them because I'm giving them too much credit for their non-operating items because those are one-offs coming out of the pandemic. Yeah. Peter?
Yes. To go see on the flip side of the recent question, how does it affect this new model versus the old model, the valuation that the firm itself has for its own company? Like if Apple were to value itself to the traditional model, would they miss out on massive profits that they could have, or any other company?
They don't. Apple's sophisticated enough, and the banks that work with them and the funds that own them are sophisticated enough.
Correct.
I'm telling you.
But like
And-
other models.
Well, the reason why, and again, there's nothing wrong with the other models. The other models are conceptually sound. But my answer to this is just the old guy that I've turned into. All right. I went to Wharton in 1986.
Mhm.
All right. So I'm at one of the top business schools in the world. And one of the advantages of being at Wharton in the 1980s is all of my finance professors were PhDs from Chicago. So the people at Chicago wrote the textbooks and they were writing them as they were winning the Nobel Prizes in the 70s and early 80s. And then they went to the top schools. And I was fortunate because I had some of the people that were at Chicago, they were trained in the PhD programs that were working for the people winning the Nobel Prizes that were my finance professors, using some of the first editions of the finance textbooks that you are now using today. And my whole point of saying that is that it really was a simpler time, because in the 80s, when I took accounting, like the whole idea of a company having $160 billion worth of cash sitting in a bank that wasn't paid out because of international taxes wasn't even contemplated. Nobody did that. Non-operating assets were trivial and barely existed. The idea of other companies becoming conglomerates and owning pieces of other companies that they didn't control, right? And just having all these joint ventures, cross-border joint ventures, that didn't happen. It was a very rare occurrence. So when they built the formulas in the 80s, which by the way, have not changed in 50 years, there weren't any non-operating assets. So the original textbooks kind of ignored non-operating assets because all the assets were, for most companies, pretty much operating outside of a bank. So therefore, the formulas didn't have to contemplate this stuff. But what I'm telling you is the world changed over the last 50 years and the math didn't. And that's what McKinsey picked up on, because McKinsey tried to say, look, we need to start to address some of the limitations we're seeing in some of these original models based on what's going on in the real world. And so one of the limitations they addressed, and I talked about this last week, is that, problem with IRR, whatever you make in the past equals whatever you make in the future. Well, that's a limitation. They tried to improve upon that. And then the other reason they adopted Modigliani-Miller is they said, look, there are non-operating assets. We do have to value them separately. They are growing at different rates, and they do make different rates of return than the core businesses. And the models are missing this. And the more sophisticated banks started adopting these processes. And so that's what I'm saying, like, people get this now on Wall Street, but it's not caught up in most of the textbooks. And it's not caught up in most of what you would have learned coming into this class. That's why it's called the advanced class, right? And so there's nothing wrong with the models. It's just the world changed. And we're using stuff that was developed in the 80s when the world was a simpler place. And so now when you apply those today, it just misunderstands companies. So if you're doing a Parker Hannifin, you're probably not going to misunderstand it because they don't have a lot of non-operating stuff. You do a company like Apple, you're going to be clueless as to why they come up with a $3 trillion valuation. You're just not going to make sense out of the model. You're going to look at that model when you forecast it, and you'll be like, I can't understand why Apple is worth this much. And you're going to go out there and say they're overvalued. And what I'm going to say is you misunderstood Apple. I'll get off my high horse, but that's kind of what's going on. All right, so back to our homework assignment. Let's go through the solution that I posted online. So I am going to solution. Share that. I'm trying to open this. Excel, where's Excel? Version solution, there it is. Share Excel. All right, so what I did here in this homework assignment, I gave you 3 historical years of income statement and balance sheet. Although one of the important things to understand is the income statement ends here. So even though I gave you dividends listed on row 13 and 14, they're actually not part of the income statement. They're part of a third statement called the statement of cash flows, GAAP statement of cash flows. But they're critical to doing our CFI, so I put them there under net income. So when we do TII, you stop at net income. Dividends are not part of TII. Okay. Also, I gave you a balance sheet. And this is also something that I gave you that's not going to be typical when a company reports out its balance sheet. A company doesn't usually break out operating cash and excess cash. That's a McKinsey approach. Okay, most companies don't do it. Most companies treat all cash as excess cash. That actually feeds a concept known as net debt. Right? If you heard about a concept known as net debt, you take your debt minus your cash. That's called net debt. Debt minus all cash. Right? And that's what they teach you in most of your finance classes. But the realistic problem with net debt is that if a company ever goes into receivership, goes for bankruptcy, like your Bed Bath & Beyond as an example, they can't take all the cash and pay it out to the debt holders. The court won't let you. Like if you go into bankruptcy, the first people to get paid is who? Who does the court set aside if you go into Chapter 11 bankruptcy or even Chapter 7? Who gets paid first? And the court will instruct the receiver to hold the cash for this group of people. Yeah.
Debt holders.
Nope.
I would think
Oh, would be accounts payable.
Nope.
People
the court itself.
It's the lawyers.
Yeah.
The lawyers will get priority over everybody. And the court will allow that to happen. Then what they'll do is if you have what's called DIP financing, debtor in possession financing, after bankruptcy, if you come in and make a short-term loan to the company, they'll put you at the top of the list. And they'll go over the secured lenders and everybody else. And that is a boutique business on Wall Street. Then they're going to pay the employees. The courts are going to make sure that wages are paid to the employees. And then they're going to make sure that the taxes that are owed to the federal and state governments are taken care of. After all those people get paid, then they'll distribute the money to the debt based on seniority. And usually there's nothing left by the time you get to the shareholders. Not if you're in receivership. But that's the point. You can't take all that cash and just give it to the debt holders. Ain't going to happen. Not in the real world. So that's the point of excess cash, right? Which is, yes, you could say debt minus cash, but the reality is you can never pay out all your cash. There is no company, even if you're not in bankruptcy, that can pay out all your cash because then they'll just simply stop functioning. You won't be able to make payroll. Right? You won't be able to run your business day to day. So I'm telling you, as a former CFO, you know, when you're running a business, like we had to have about 30 days of cash on hand or the business was going to have trouble operating. So no matter how much cash we had, we could never take 30 days and kick it off to our parent or use it for operations. We had to keep it for working capital. That's operating cash. So one of the things that McKinsey does is they will separate out operating cash from excess cash. And they have several ways of doing it. The easiest way is to talk to the company themselves. Most treasurers, most CFOs, they kind of know, like, I need this much cash to run my business day to day. That's the cash. It's like inventory. It's just working capital. I can't use it to pay dividends. It's not part of free cash flow. Anything above that amount, sure, I can distribute it. That's the excess cash, right? The rule of thumb that I've been using with most students is 2% of sales. And the reason I use 2% of sales is it's 1 week of cash. Okay, 2% of revenue is 1 week of cash, right? There's no company I know that can operate with less than a week of cash. Not going to happen, right? I don't think many companies can operate with a week of cash. So that's actually probably understating what the operating cash is. But that's the whole idea of operating cash and excess cash, right? So if you're doing some work this semester and you're just trying to estimate an operating cash balance, 2% of cash is a simplistic assumption that you're able to use. But the reality is, and the book talks about 3 different ways to estimate this, you really kind of want to have a better idea for the nature of the industry, the nature of the business when you do operating cash. But so 2% is like a floor. But then all the rest of the cash is excess. And I'm saying financial statements don't show us this way. For purposes of your assignment, I already broke it out. Operating cash, excess cash. Right? The other thing is, accountants don't give you this. They don't give you labels 1, 2, 3, 4s. Okay, McKinsey doesn't do that. I actually started it when I used to be part of teaching the analyst training program at McKinsey. I had to basically do some non-business people in a couple of days how to do what you're doing, and they've never taken finance classes or accounting classes. So I had to come up with a simple way to help them identify buckets. So this 1, 2, 3, 4 is Joe's methodology. Okay, you don't have to use it, but I'm just telling you, part of your homework assignment for next week as well is you're going to go through statements without the 1, 2, 3, 4s and try and figure out what's operating and pull out the operating items. Okay, so for this assignment, I kind of told you what's operating, right? But the general idea, and these should probably carry over to most real world statements, but when you deal with a real world statement, you got to kind of figure out what's operating, what's non-operating, right? And the rule of thumb is if it's driving sales, it's operating. Okay, so that's the whole idea. Like, I'm using this on a recurring basis to make sales in the normal course of business. That's a 1, that's operating. If it has nothing to do with sales, and if I didn't have it, I could still sell my product, then it's non-operating. Okay, that's the big difference and distinction. Again, for this assignment, I kind of helped you understand that. The other key part is what's debt. Debt, which I'm calling 3s here, anything that's interest bearing. Either actual interest bearing, short-term, long-term debt, or interest bearing by proxy. So for example, if I have an unfunded pension, I present value the unfunded pension liability. When you present value something, you've essentially attached an interest rate to it. It's interest bearing debt. So it's either debt or debt by proxy. So anything that's present value is going to basically be debt or interest attached to it. And then anything that's a shareholder distribution that's financing you is an equity item. Those are 4s. Okay. And conceptually, 1, 2, 3, 4s. What are 1s? Operating items. What are 2s? Non-operating items. Biggest 2, non-operating cash flows. That would be excess cash. That would be passive investments in other businesses. What is debt? Anything interest bearing or interest bearing by proxy. What is equity? Any equity cash flow in the bottom right of the balance sheet. That's what you basically did in this homework assignment. Again, I've been monologuing too long. Questions, comments, concerns, crippling fears about any of this?
Professor, there are a lot of items on this list. And if we look at the YouTube video that you showed us compared to the homework, there were some items that were on the YouTube or on the homework that weren't on the YouTube video. Are there other items that might be on like an income statement or a balance sheet that we're missing from the homework?
Well, here's the idea. You see this statement?
Yes.
So let's go, let's say, I'm not going to, but let's say I gave you Apple. Maybe I should for your next week's homework assignment. But let's say I gave you Apple. Here we go. Here's their balance sheet as reported. This is what you're going to get. You're going to get the actual balance sheet that the company reports. And you got to go through it and figure out what's operating, what's non-operating, what's debt, and what's equity. Some of them pretty straightforward. Cash equivalents, great. I know that there's operating cash there. I know that there's non-operating cash there. How much cash for operating am I going to call Apple? Everything else is excess. Marketable securities. That's part of the operating excess cash balance, but my guess is marketable securities are probably going to be mostly excess cash. Accounts receivable, that's operating. Inventory, operating. Other current assets, is that operating? Is it non-operating? Probably should be reading the footnotes to see what it is, but most companies will call other current assets operating, which means it's recurring because you kind of notice they have it every year. Okay, it seems to be growing as they get bigger. That suggests operating. Okay. Accounts receivable for non-affiliates. We have to make a determination. Do we consider this operating? Or is this part of their financing for like the Apple Card? And if it's financing, then it's probably not operating. It doesn't have anything to do with selling iPhones. So I might call it a non-operating asset. I got to do some digging to figure that out. See where I'm going with this? See, companies don't put it into this easy to use, easy to understand format. And we often have to go figure it out.
Yeah, that answers my question. Thank you.
There's your hint as to why you're going to hate next week's homework assignment, because it's going to involve figuring it out. See, with the undergrads, I just give it to them. And I was just like, here's a statement. I've already converted it for you for the real world company. Here's all the work. You guys, I have to treat you as the advanced class. So you're going to learn how to actually do it with a real statement. So that's what your next homework assignment is going to be about. That's why you also probably want to work in pairs. Adam?
Quick question regarding like a company like Berkshire Hathaway or a holding company.
I'm not going to give it to you because
Okay.
it's too much. That's the problem. Trying to figure out a conglomerate that invests in other businesses, because Berkshire, for most of their businesses, most of what they do is non-operating, meaning Warren Buffett.
Right. Yeah.
run the
Cash flow
company.
from investing cash flow from investing activities versus operate. Yeah. It's not a clear distinction.
Exactly. And that's why I wouldn't do that to you. I'm going to give you like a real company that has operating assets. So
Okay.
it'd be like a Costco or somebody like that. I'm not going to give you too complicated a company, but the point is I wouldn't give you a Berkshire. Berkshire would be too difficult because almost their entire business is non-operating. And I'm doing a bunch of non-operating assets because basically they're a fund manager. So banks and financial services are unique animals and they're not part of how we do this class. There's actually some chapters in the book if you want to go read about that, but it's much trickier because the biggest problem with a bank is interest expense. Meaning if I tell you Costco has debt, you could pretty much assume it's a debt number 3 on the Modigliani-Miller debt cash flow. But if I tell you JP Morgan Chase has interest expense, well, they have a net interest margin because they charge you interest for your mortgage and then they borrow interest from a savings account to fund the mortgage. And the difference between the two is their gross margin. So the net interest margin of the bank includes interest expense. But JP Morgan also has debt, which is part of their long-term capital, which finances their business. So which debt is net interest margin and which debt is part of long-term capital? We're not getting into that. That's just way too complicated, right? But nonetheless, we do have to start to understand what's happening here. All right, so back to our homework assignment for last week. This is where the training wheel's on. That's why I'm giving you the formulas to help you better understand what we did in the conversions. So with these statements, income statement, balance sheet, it doesn't matter which statement you convert first. you have to convert the income statement to balance sheet. Right? I usually do the balance sheet first because it's easiest. Right? But you can do the income statement or the balance sheet. They're independent of each other. You have to convert both. And then you do those two statements, create the cash flow statement, the CFI. So you have to do the income statement and balance sheet to get to that cash flow. And that's probably the one that most of you struggled with. Okay. But nonetheless, TFI was the first one. The whole point, that's why labels are helpful, is you start with this balance sheet. You take all the assets that you've identified as operating, all the liabilities that you've identified as operating, you net them together. That is invested capital. Now, in this solution, I went an extra step that you wouldn't have had to do for the homework assignment. And the reason I did the extra step is it sets up the valuations that we're going to do. Okay. And I broke out working capital separately than long-term capital. For the same reason that I told you that we forecast operating and non-operating grow at different rates. Generally, working capital and long-term investments like plant grow at different rates. So we tend to forecast them into these two buckets so we can grow the buckets at different rates. All right, so you don't have all of your capital growing at the same rate. Like the level of inventory doesn't grow with building a bigger plant one-to-one. So I might want to forecast my inventory volume growing at a different rate than my plant volume. So this solution breaks out long-term and operating capital. You didn't have to do that as so long as you came up with this number for your operating invested capital, but that's the whole point. Operating assets, operating liabilities, netted. Then, same process. Non-operating assets, non-operating liabilities, netted, add TFI. That's your non-operating capital. Right? And then your debt and your equity capital, and then they have to add. They have to basically match. And this is, again, another stickler of Modigliani-Miller. The whole point of Modigliani-Miller is in most classes, they stop. They basically do half the statement, and then they don't do the other half of the statement. Since Modigliani-Miller has to balance, we balance in this class. And the advantage of balancing in this class means you're less likely to make a mistake. And it's a pain in the ass, but it generally gives you better statements because you're less likely to forget something. Because I had several students who emailed me that said, I'm struggling with the CFI, right? And the answer for every single one of those is not everything was on there. Okay. And that's the problem. Like if you don't try to balance, you won't know that you forgot to put stuff on a statement, because you never had to worry about balancing it. When you balance a statement, you know that you had to account for everything. So again, it's extra work, but it actually is good hygiene. All right. So again, you guys see the formulas, you can see where things came from. But my question is, questions about the TFI. Hopefully pretty straightforward. This was the easiest of the 4 statements. And again, you have the solution online. Actually, this is not the one that I uploaded. I uploaded the one with the formulas. Let me open the one with the formulas. All right, second statement was TII, same concept. We basically took the income statement. Open that one. Share this one, which had the formulas. This one I gave you. TII was the rearranged income statement. Operating, we generally assume EBIT is operating income. That's just an assumption we make in the real world. Generally, EBIT, which is earnings before interest and tax, doesn't include non-operating items, but every now and then it does. So technically, we should use operating income, but for your purposes, if you use EBIT as operating income, it's probably going to be close enough. And for the company that I'm going to give you for your homework assignment, you're not going to have an issue. Right? So EBIT, operating income. And then the other key part is tax. So basically, we figure out an effective tax rate for the company. So in this case, easiest way to do it, you can see it right here, is either I tell you what the tax rate is, or you can take your taxes and income before tax, divide, and basically get an effective tax rate. Right? And then basically you use that tax rate for all three sections. So basically, if we were a clean company that didn't have any debt, what taxes will we pay in our EBIT? That's no pattern, no plan. Operating profit after tax. Okay, same thing. Take our non-operating income items, tax affect it at the effective tax rate, non-operating income after tax. That's our non-operating income. Operating income plus non-operating income, total income available to investors. Debt, same concept. We can deduct the interest expense, tax shield. So basically, effective tax rate times the interest expense is the after-tax interest income. Minority interest is already after tax, you don't double tax it. And then your net income, dividends are not part of TII. Sum up these, TII equals TII. This is the income we generated. This is the income that we paid out. Both sides will balance. Payouts are positive numbers on the side of the statement. Yes, sorry, the hand up.
I just have a question about you showing us how to calculate the tax rates. How does deferred taxes and
So the easiest way,
depreciation and how those come?
I would say the
Okay.
easiest way when you're doing this, like on this assignment, I gave you a tax rate.
Okay.
Okay, when I give you your real world company for next week, you're gonna have to estimate the tax rate. And I'm just saying for an effective tax rate, the easiest way to get it is just to look at the taxes that they pay on their income statement, because they'll be broken out, and divide it by the income before tax or the pre-tax income.
Okay, yes, I guess my question really,
30% here.
okay, I guess my question really is for some companies that do defer taxes, that do all that, their tax rates may not be easily calculated from the financial statement.
Well, I'm just saying you're going to find it one of two places. So again, if you go back to a company like an Apple, if you don't see it here on their income statement as reported, which you probably would, like there's their income tax expense and there's their income before taxes. So you can divide and come up with a tax rate. And that's the tax rate that you would use on your statements. If for some reason it didn't show you this number, which I can't imagine an accountant wouldn't put the tax expense on an income statement. But if you didn't see it on the actual P&L, you'd have to go looking through the footnotes. Because in the footnotes, there'll be a footnote on taxes paid. And in there, you could basically estimate a tax rate if they didn't give it to you.
Okay, I guess what's confusing me, maybe I'm not phrasing it properly, is are we supposed to be using the effective tax rate or the company actual tax rate? Because a lot of times the effective tax rate is different from the company tax rate.
Correct. So we're going to use the effective tax rate.
Oh, okay.
Because the problem is the US federal tax rate is 21%. And I've yet to find a company that actually pays 21%
Okay.
out of the S&P 500. Most companies are like 14, 15, 16. So
Okay.
if we're trying to balance statements, we want to use the effective tax rate based on what they're actually paying. Because, and that goes back to the TII, when we split out on this statement, taxes of 90 as an example, into the three sections, tax on EBIT 93. Tax on non-operating income, what's that? 100.2. Tax shield 16.2, 100.2 minus 16.2. That's going to give you 90, whatever it is. So that whatever taxes we pay will be equal. We're just spreading them out for the three sections. So we still want to end up with our statements showing the same taxes. We're just putting them into, these are my operating taxes. These are my non-operating taxes. these are my tax shields. But they'll still net to the actual taxes the company paid. That's why we have to use an effective tax rate. Questions about that? All right, questions about the TII in general? At least for the people that were asking me questions, they didn't really have trouble with this statement. They had this one balancing. Third statement was CFI. The important part to CFI is that, first of all, we have to get our free cash flow right, which is gross cash flow minus gross investment. Gross cash flow is no plat plus depreciation. Got to add back the non-cash items. And gross investment is change in operating invested capital plus depreciation. And essentially that is your free cash flow. That was the shortcut I gave you. But again, this is the detail you can see here. Free cash flow plus non-operating cash flow equals CFI. And these were the non-operating items. For the people that were having trouble that sent me an email, they just forgot non-operating items. Change in excess cash, change in equity investments, change in other long-term non-operating liabilities, which are pretty rare for real world companies, by the way. And after tax interest income is actually non-operating item. Because the whole idea is that it should be matched with the balance sheet item. Meaning I earn interest income on excess cash. Therefore, it's a non-operating item because excess cash is a non-operating cash flow. It's not a debt item. That's actually another shortcut that they make in other textbooks, where they'll use a net interest expense. They'll net interest income against interest expense. That's conceptually not right. Because interest expense is a debt cash flow. Interest income is based on excess cash. It's a non-operating cash flow. We separate those out in this class. And then on the CFI financing side, it's interest expense to the income statement, change in debt on the balance sheet. Dividends is not net income because net income is not the cash flow. Dividends are the actual cash flow. That's why you don't use the TII net income here. You do, it won't balance. And then change in equity, the big part is retained earnings is not a cash item. So a change in a non-cash item does not affect cash flow. So we don't use change in retained earnings. Those are the curveballs on the financing side. And then it's just a question of signs. And the simple way in the TII and the CFI to think about it is if the cash is leaving the business, it's a positive number. If the cash is coming to the business from a debt holder or equity holder, it's a negative number. That's the way the Modigliani-Miller statements are structured. So the whole idea is I have $200 million worth of cash to distribute. How did I distribute the $200 million worth of cash? Distributions are positive numbers because they have to match. I am short $227 million worth of cash. Where did I fund the $227 million? Cash coming into the business is a negative number. That was CFI. Anna?
Yeah, quick question. So for depreciation, if you remove depreciation because you have them on both lines of the equation, it doesn't affect free cash flow. Is there a reason why it matters?
It's because right here, it's because of the formula for capital expenditures. Working capital is a straight change. Change of goodwill is a straight change. Liability is straight change. This is not a straight change. The reason why is if I were to write out a formula for solving for CapEx, what I would do is I'll take my starting PP&E balance. I would add my capital expenditures for the year. Spell CapEx today. I would add my CapEx. I would then subtract my depreciation. And that would equal my ending PP&E balance. Okay, that's accounting. Okay, if I was just conceptually, how would the accounting work? Keeping outside the T accounts, that's how the accounting would work start with my PP&E, add the CapEx, subtract depreciation, that would give my end PP&E. So here's the point. What's the formula for CapEx if we rearrange? CapEx rearranging equals my ending PP&E minus my starting PP&E. The change in PP&E, just like the change in working capital, change in goodwill, plus depreciation. So when I add these up, every one of those is a change, except for CapEx, which is the change plus depreciation. Which I can't spell right. So that's why the simplified version of the formula is change in invested capital plus depreciation because of the CapEx. That's the lingering part of the equation when you actually add it up. Okay, because it just goes back to the way CapEx is calculated. None of the other things have depreciation attached to them, with the exception of CapEx, property, plant, equipment. So therefore, when we actually solve for gross investment, it's the shortcut is basically change in invested capital plus depreciation. It's the change in each one of the items above plus that depreciation, which carries all the way down. Good question. Other questions about the CFI?
Professor, could you explain line 25 minority interest? I'm not sure where that's coming from.
So there are two minority interests that come from accounting. Okay, so there's the minority interest on the balance sheet. Right now, here's the point. Go back to the balance sheet here. So if I make an investment where I control another company more than 50%, but less than 100%, under accounting rules, I consolidate that company as if I own 100% of that company. Okay. And what I would do is on my balance sheet, I would have common shareholders that own a piece of my business that I have consolidated, but those common shareholders that I've consolidated don't own the rest of my business. They only own this business that they have a controlling, or I have a controlling interest in. But I treated it as if I owned 100% of that business plus everything else. So what the accountants make you do is they make you take the common equity interest of those minority shareholders, and it's called minority interest, and you put it on your balance sheet as money that you owe to those shareholders, which is different than what you owe to your common shareholders. Because they get a share of the profits for the business that was consolidated. They don't get a share of the profits for the rest of your business. They don't own the rest of your business. And so to separate them out, it's called minority shareholders, minority interest. That's what shows up on the balance sheet. So anytime you see in a balance sheet, minority interest, it's basically a company that controls 100% of the business, or sorry, it controls more than 50% of the business and consolidated 100%, but they actually don't own 100%. So that portion that they don't own, minority shareholder interest. On the income statement, what ends up happening is the IRS doesn't want to go tracking down taxes that you've distributed to the minority shareholders. They say, look, if you control the company, you owe the taxes. So what you do is you pay taxes on everything, all the profits of all the businesses you own, including the taxes that are owed in the minority share that you don't control, because you control the business. So you pay the taxes. Then what's left after tax, that of the share of the business that the minority shareholders own for that one subsidiary, that is the distribution, which is really an after-tax dividend that you would give to the minority shareholder. That is the income statement minority interest. So this is the distribution of profit to the minority shareholder for their interest that you said you control after tax. This is the amount of equity that you owe them for consolidating all the assets of your business. Sorry, that's accounting. We have to deal with that.
I guess I appreciate that. I guess I'm just still unsure where I would even find the, what did you have there? 20, the numbers were all different, on the CFI. Could you go back?
So on the CFI, you'll see, and that's why I gave you the formulas.
Okay,
This is the minority interest, which is the dividend payment to those minority shareholders. That's coming from the income statement, TII A19. You can see the cells up top. This is the change in the balance sheet minority interest, which is the actual equity account of the minority interest. You have to account for both.
okay,
Payment to the minority shareholders, change of the total minority shareholder investment. So basically the whole idea here is the minority shareholders, they didn't change the stake in the business that we owned. And any profits that we had, we just gave to them. In the form of dividends, but those were after tax because we've already paid those dividends.
got it. Okay, thank you.
Yeah, sorry, the accounting gets a little bit more.
Could you say
Convoluted.
one more time, on the balance sheet, what it is, the equity you owe them? Could you explain that one more time?
So I have a business that has $1,000 worth of assets. Okay, and let's assume it has no debt. So I have $1,000 worth of equity to account for. Okay, but here's what's really happening. Somebody owns 30% of this. So what happens is I would have in this equity account, 700 belongs to my common equity. And 300 belongs to a minority interest equity. So I would put this 300 on my balance sheet separately from my common shareholders. This would be in my common equity. This would be on the minority balance. I still have 1,000 equity that equals 1,000 of assets. Okay, but except it's more complicated because practically I don't have 1,000 of assets. What I have is in this subsidiary assets, I have 1,000, but the rest of my assets are, let's just say, keep the whole numbers wrong, 9,000. So my total assets are the sum of those two. And my actual common equity is 9,700. The minority shareholders own 300 of the 1,000. And so my total equity would also be 10,000. So there's a piece of this business that they own a part of that, but they don't own that. So I had to break them out. Can't say that they own that. That's what these people own. They own everything. But some of this is owned by these people. I break it out. That's what shows up on the balance sheet. Okay, same thing. I make income on the 10,000. All right, so I make income of 1,000. So my ROI is 10%. Okay, 10 equals 1,000 divided by the 10,000. I can't give 10% to my shareholders because what I had to figure out is how much income did I make on the 1,000? And then 30% of that is going to go to these people. So I got to separate that out. I can't give them all $1,000 worth of income. So what income did I make on this 1,000? And what's 30% of that? That is the minority interest on the income statement. I'd have to figure out how much profit belongs to them and then pay them a dividend. I had to give them the cash. And by the way, if I didn't give them the cash, then that balance would grow, just like retained earnings, by the amount that I owed them, because I still have to account for the fact that I owed you money. So either give it to you as a dividend or to increase your stake. Okay, or I could overpay your stake, like buying back stock. So if I paid you more than you were owned at income for whatever reason, then your minority interest stake would actually go down. And I would still show the actual cash distribution on the income statement. That's minority interest on the income statement. This gets complicated, and I can tell you your next week assignment won't have this. Other questions about the CFI? But again, here's the important part of CFI. I know how much cash the company generated from operating activities. I know how much cash the company generated for non-operating activities. Add them together. I then have this amount to distribute. I know my company spent more money in investment than it made in sales. I had negative cash flow from operating activities. I didn't make it up from non-operating activities. I'm short money. Where'd it come from? That's the other side of the statement. And then the third statement, economic profit. Think of economic profit as a one-year NPV. Basically, in one period of time, am I creating or destroying value? So the simplest way to think about this is, how much capital do I have tied up in a business? What's my WACC? Capital times WACC is called the capital charge. So if I have 3.2 billion, 3.26 billion of invested capital, and I need to make 6% a year, 6% of 3.26 billion is 195.6 million. How much after-tax profit did I make? Was it enough to cover the financing charge, the capital charge? If not, I didn't create value. That during the period is my shortfall in income in creating value. If I did have a positive economic profit, that means I created that much value above and beyond my WACC. So economic profit is basically the dollars of profit that you either missed in hitting your WACC or exceeded above the WACC that you made. So it's just a one period change in value of the firm. That's economic profit. It's called EVA, economic value added, created by Stern Stewart, but the trademark term. So the rest of the world has to call it economic profit. All right, you have the solution. You have the data. Here's what I want to do. I know this was kind of like an intense technical side for the last hour and a half. I want to take a 10-minute break. On the other half of the break, we're going to talk about two things. One, the other homework assignment you had to do. And two, the practical application of how to interpret these statements. Okay, so that's what we're going to do after the break. So it's 7:50. I'm going to pause the recording. We'll start back at 8 o'clock. So I'm going to jump to the lecture notes. We're going to start here. So this is Starbucks. I assume everybody is familiar with Starbucks. And this is a 5-year historical ROIC tree of Starbucks. Okay, so what I've done on this tree, taking the operating items, is using only operating items. I've calculated Starbucks operating end of year ROIC. The acronym EOY means end of year, which means it's based on December 31st data. Okay, in the homework I had you do beginning of year. Here I'm just using end of year statements. Okay, now when we do a tree, which is going to be your next week's homework assignment, there are two levels of the tree. The first level of the tree explains the drivers of ROIC. There are three drivers of ROIC mathematically for any company, always. The first one is the tax rate. The second one is their operating / EBIT margin. And the third driver is the productivity or efficiency of investment. Those three things explain a company's ROIC. The second level of the tree takes the operating margin, looks at the income statement, and says what drives your EBIT margin. Three items off of the income statement. Gross margin minus SG&A minus depreciation equals EBIT. So those are the three drivers in the income statement that drive operating margin. The second level drivers of the balance sheet, which is what drives productivity or efficiency, are working capital, PP&E, and intangibles. That includes goodwill. You add those three things up, working capital, PP, and intangibles, you get the productivity of your balance sheet. So the second level drivers explain the first level drivers. The first level drivers explain ROIC. So let's look at Starbucks. This is a 5-year tree. So it's got 5 historical years, in this case from 2017 through 2021 with real data from Starbucks. Okay. And what it shows is that in 2017, Starbucks after tax ROIC, all the way here on the left, was 48.3%. Use the laser pointer. And 5 years later, it went to 32.9, 41.2, 7, and then 23.2 at the end of 2021. A 5-year percentage change, dropping their ROIC of 51.9% over 5 years, went from 48.3 to 23.2. There are 3 reasons that this ROIC changed. Reason 1 is the rate of taxes that they pay. In 2017, their tax rate was 33.2%. In 2021, their tax rate fell to 21.6%. It's a 34.9% drop in taxes. Did that help or hurt Starbucks's ROIC? If your tax rate goes from 33 to 22, does that help or hurt your ROIC? It should help your ROIC because you're paying less in taxes, therefore you got more GoPlat and therefore higher ROIC. So a drop in taxes should help Starbucks ROIC. Is that what happened at the end of the year? Did their ROIC go up? 48.3 to 23.2? It did not. So despite the fact that they're paying less in taxes, the performance of the business still went down. So the pre-tax operations got worse. The pre-tax operations of Starbucks, they made a 72% ROIC pre-tax, EBIT divided by invested capital in 2017. In 2021, it fell to 29.6%. So all of the decline in after-tax performance was because the business got worse, not because they're paying less in taxes. Paying less in taxes should have actually helped them. So this driver should have helped their ROIC. So the business got worse. Why did the business get worse? Drivers 2 and 3. Driver 2 is the operating, also known as EBIT margin, EBIT divided by revenue. In 2017, their operating margin was 18.5 cents. You buy a cup of coffee, make 18.5 cents of cash profit. In 2021, selling the same products, they made 16.8 cents, a drop of 9.2% in their margin over 5 years. Over 5 years, is this better or worse? Going from 18.5 to 16.8. It's worse. So they are making less on every item that they sell. That's one of the reasons why their pre-tax ROIC went down. The third item is invested capital to sales. In 2017, they spent 25.5 cents of investment on their balance sheet to drive a dollar of sales of operations. Operating investment of the balance sheet per dollar of sales in the operations. In 2021, to sell the same products, they had to spend 56.6 cents of balance sheet to drive a dollar of sales. Is that better or worse? 5 years later, between 2017 and 2021. That is much worse, as Avery said in the chat. So Starbucks is spending more than twice as much to sell the same products. And when they sell the product, they're making 1.7 cents less per dollar every time they sell a product. So they're making less, it costs them more to sell it, and that's why their pre-tax ROIC went down. Mathematically, operating margin, driver 1, driver 2, driver 3. Driver 2 times driver 3 is pre-tax ROIC. These two things create that. These two things create that. That's the first part of the tree. So the first thing we want to understand for any company is how these three things change, because these three things affect your ROIC. What happens to your tax rate? What happens to your operating margin? What happens to the amount of spending to generate sales, which is what we're going to call productivity or efficiency. In Starbucks' case, they're spending more to drive sales. They make less profit on every sale, but they do pay less in taxes. But the net of that is their after-tax ROIC fell from 48% to 23%. That's the story of Starbucks over the last 5 years through 2021. Questions? That's what's called the first level drivers. Here's the second level drivers. Go ahead.
So you're saying that multiplying the operating margin times invested capital over sales is the same as EOI pre-tax ROIC?
So here's the algebra. Operating margin, simplistically, is profit divided by sales or revenue, P over S, right? Return on invested capital, simplistically, is profit divided by invested capital, okay? This P over I is ROI. It's the way investors think. P over S is the way companies think. Companies think, when I sell something, how much do I make? Investors don't care about sales. Investors, think about this, your own 401k, or you invest in the market. I just want to return on investment. I gave you money. Did the stock price go up? Did you give me a dividend? That's all I care about. I care about ROI. It's return on investment. So the question is, how do we connect these two? How do we go from margin, P over S, to return on invested capital, P over I? Well, algebra tells me that I can multiply P over S by blank over blank, and that will get me to P over I. So what's my blank over blank? What do I multiply P over S by to get to P over I? What's this got to be? Do we remember our algebra?
S over I.
Great. So what this multiplication sign tells me, even if I don't know what the acronyms mean, equal weight. This has just as much weight as that. And there are two drivers of return on investment. Okay, one driver is profit over sales. How much do I make when I sell something? That's this. But there's a second driver, sales over investment. Okay, how much do I spend to generate sales? That's S over I. Spend invested capital on the balance sheet, generate sales, revenue on the income statement. I call that productivity or efficiency. That's this number. Here's the only difference. You'll notice here, I've done a reciprocal. So instead of S over I, I'm doing I over S. So the actual math is P over S times 1 over this number is P over I. But I'm just doing a reciprocal here, right? And I'm doing this reciprocal for 2 reasons. Practical reasons. When you talk to a company, and I talk to a lot of companies, the average employee doesn't think in terms of ROI. The average employee thinks in terms of dollars of revenue. How much do I make when I sell something? How much do I spend to sell something? Everything is internally, it's dollars of sales. So I just put it in language that's easier for most people to use. I over S instead of S over O. Same thing, just reciprocal. Other reason is if I put everything in terms of sales, I'm going to be able to add it together. So we get to that next level driver, I can add these 3 things together to get that number. And that's going to be important for our second level analysis, right? So all I'm saying is practically this times this equals that. The honest answer is, here's the formula, this times 1 over this is that, but these 2 still have equal weight. All right, so that's what I'm saying, 3 drivers. This margin, how much you spend to generate sales, and your tax rate always will explain ROIC for any company. This is operating. Everyone with me so far? And we got a story of what's going on with Starbucks. Second level drivers. What drives operating margin? Operating margin is EBIT divided by revenue. Okay, now I go 1 level down, click down on the income statement. Start with gross margin. Gross margin, basically revenue minus cost of goods sold is gross profit. Take as a percentage of sales called gross margin. So this is basically price minus cost, the direct cost of goods sold. Okay, that's gross margin. Minus my indirect expense, minus my SG&A, selling general administrative. That's my overhead costs. And then the third element that we're breaking out is depreciation. Most companies will bury depreciation in either gross margin. Every now and then you'll see them dump it into SG&A. We're going to take the non-cash depreciation out. So this is cash gross margin, cash SG&A, depreciation. Gross margin minus SG&A minus depreciation equals EBIT. This is basically EBITDA. EBITDA minus depreciation, EBIT. These are the 3 things that explain the operating margin. So let's talk about Starbucks. When they sold a cup of coffee in 2017, price minus cost, they made 35 cents. When they sold a cup of coffee in 2021, price minus cost, they made 34 cents. They're making 1.2 cents less every time they sell a cup of coffee. Their markup on their coffee went down. Didn't seem that way when you walk into a Starbucks, because probably it's not just the price going up, it's the cost of coffee went up further. All right. Second, how much are they spending on marketing, overhead, shared services? That's SG&A. 2017, they spent 13.8 cents to sell a cup of coffee per dollar of revenue. 2021, 13.4 cents. Went down slightly. So they make less every time they sell a cup of coffee, gross margin down. Overhead rates stayed about the same. Depreciation. 2017, they spent 4.8 cents per dollar of revenue on depreciation. 2021, 5.2 cents. So why is their operating margin lower? Because their gross margin went down and their depreciation went up. Those were the 2 things that compressed their EBIT margin. That's the second level click down. Second level click down to the balance sheet. Invested capital, you did the conversions, 3 things. OpWC, working capital, operating working capital. That's your operating cash, your inventory, your receivables, net of your payables, primarily. In 2017, Starbucks had negative 5 cents of working capital, which means they had more accounts payable than receivables and inventory. Kind of like Apple, when we looked at Apple earlier today. In 2021, they had negative 7.5 cents, which means they had more accounts payable relative to receivables and inventory. That reduces your invested capital. Okay, because these three things summed equals this. So -7.5 cents versus -5 cents. They had more negative working capital. That reduces your invested capital. How much they spend in their stores, property, plant, and equipment. 22 cents per dollar on the stores and the stuff inside them in 2017. 2021, 50 cents per dollar on stores and stuff inside them. They more than doubled their spending on their stores. Intangibles, this is acquisitions. They spend about 9 cents per dollar on acquisitions, goodwill. 5 years later, almost 14 cents per dollar on goodwill. They bought somebody. Matter of fact, the big jump in goodwill was in 2018 when they bought, who's that coffee company they bought? They bought somebody, Canva or somebody like that. Starbucks made a big acquisition, but that's the point. They spent on an acquisition that basically cost them about the acquisition premium, about 5 cents per dollar, going from 9 to 14. They spent 27, 28 cents per dollar more on property, plant, equipment. 28 cents plus, we say 5, that's 33. They saved 2.5. So that's about a 30%, 30 cents per dollar increase, 25 to 57, 26 to 57. All the increase was primarily driven right here. PP&E to sales went up, which actually reduces your return on invested capital because you got more capital, and they spent more in intangibles. So if you really want to see the story of Starbucks over the last 5 years, for this 5-year period of time, they got lower margin because their gross margin went down. They spent more in their stores and depreciation. On the balance sheet, they spent a lot more on the actual stores, invested in the stores, and they bought a company that really hurt their productivity. They spent more to make less, driving their ROIC down by more than 50%. Their tax rate went down, which somewhat benefited them, but the overall after-tax ROIC of Starbucks went from 48 to 23. Questions?
Professor, can we plug in like the 22 numbers here? Just obviously the pandemic in 20, you know, they were on a little bit of a downward trend, but that like really hit them. And it seems like some of the investment was kind of based off of the back of that to try and get things back, but potentially 22 looks better and they've sort of corrected their trend and they're moving in the right direction. But if we take valuation here, you know, we maybe undervalue them.
As I said, right now we're looking backwards. We'll talk about looking forwards soon. But right now we're just looking backwards, and you're right. It would have been nice if we had 22 data in this chart, but for purposes of just understanding the tree, I'm starting with this historical tree. Just a minute, we'll include companies that have 22 data, but this is just the process. I want to make sure everybody understands the process. Right? So I'm going to put up another company. Target. You guys heard of Target before? Also known as Target. Same 5-year period. Tell me about Target. End of your ROIC. Better or worse over 5 years?
Better.
Better or worse? It's a lot better. 13.5 to 20.5. Right? Tax rate. Did that help or hurt the ROIC at Target over 5 years?
Help.
That helped them. So one of the reasons why their ROIC improved is because their tax rate went down. Matter of fact, when did the tax rate really go down for Target?
2018.
Why did it go down in 2018 so much?
Tax cuts and jobs act.
These were the tax cuts that the Trump administration got Congress to pass. So the Trump tax cuts benefited a lot of companies. The tax rates all went down. Helped Starbucks, helped Target, helped a lot of other people. Right? In terms of their paying less taxes. All right, so they paid less taxes. That's one of the reasons why the ROIC improved. Was that the only reason? Did their business get better or worse?
Better.
It actually got better. Went from 20% pre-tax to 26% pre-tax. Was it because the margin improved or was it because the productivity got better? Did Target's margin change over 5 years?
Not really.
Actually went down a little bit, but 7% to 7%. stay pretty flat to slightly down. So that's not why the business got better. Why did the pre-tax get better?
The invested capital sales.
They're spending a lot less in capital to drive sales, 36 cents to 27 cents. They knocked 9 cents per dollar out of their balance sheet spending per dollar of sales. Let's look at the balance sheet. How did they save capital? Working capital went from 0 to negative 5 cents. So they basically pushed not paying their suppliers. That took 5 cents out of their invested capital. More negative means lower invested capital. They have more accounts payable. So 5 of the 9 cents of improvement came by not paying their suppliers. PP&E to sales, 35 to 31. They got store productivity. They got more revenue out of their stores without adding a lot of stores. So spending 4 cents less on stores, and they got 5 cents out of working capital. That's the 9 cents. And their acquisitions were negligible. They don't buy anybody. What happened to their operating margin? Stayed flat. But did anything change? Well, when we click down, the gross margin actually went down 32.6 to 31.9. They're making 0.07 cents less per dollar of sales, which matters at scale for a retail business. They had flat SG&A. So where did this operating margin recover? Because their depreciation per dollar of sales went down. So basically they got better depreciation rates by getting better store productivity, which offset a slight decline in gross margin over the 5 years. Flat margin, improvement in store productivity, the efficiency of how much they spend to drive sales led to higher ROIC with a lower tax rate, improved their after-tax ROIC.
Professor?
Yep.
And thinking about the 5 cents that they got from the operating working capital over sales, is that something we would not value as highly? Because technically they're still gonna have to pay that back, those accounts payable, right?
Great question. So when we get to the forward looking, the question is that sustainable? So the past, I like to say you got to be careful because you can't drive a car and look in the rearview mirror, right? So the danger of looking backwards is we assume the past repeats itself, and it doesn't. It doesn't always repeat itself. So when we start looking forward, when we forecast, that's a terrific question. We have to say, look, is that sustainable? Can they sustain this level of negative working capital? If they can, it's a benefit. If it starts to regress back to zero, because the suppliers get pissed off and start raising prices, and so this gets back to the power of the buyers, power of suppliers, 5 forces that you just did, then we might not give them that credit going forward. And that's going to be a driver of cash flow and a driver of ROIC. But that's for a later week. Right now, we're just looking backwards and telling a story. What do we see from the data looking backwards? Do you understand how to look through the tree, these 2 levels? Questions about the 2 levels? All right, so in-class exercise. So I'm going to put into the files folder 2 files. So where is, okay. So in this files folder for week 2, I am going to put this file. Which has real data, which includes 2022. Is it? Sorry, way too much open here. It's in here. There's a file called Parker ROIC benchmarking.powerpoint. And the other file that I'm putting in here is called benchmarking case 2022 data.powerpoint. Right, those are the two files that I just uploaded. So share my screen. In here, I'm going to start with the benchmarking case. So I do work in the real world in the defense and aerospace industry. I just did some work for a company called Lockheed Martin. And next week, I'm working with a company renamed RTX, which used to be called Raytheon Technologies. So this data has been shared with both of their companies. And so it's real data, it's public data, but it's an exercise I do with their executive team. And the idea is this is 5 years of Lockheed Martin's data as an ROIC tree from 2018 to 2022. Okay. Now, the only difference in this is there's two trees on this page for Lockheed Martin. The first tree includes invested capital to sales. It includes the three items that we just talked about. The second part of the tree excludes intangibles and recalculates the entire tree, excluding intangibles. So it's the same tree, except instead of these three things adding to that, it's these two things add to that, and this recalculates the ROIC. And you might say, gee, why does he do it that way? And the answer is because when you do big acquisitions, which they do in the defense and aerospace industry, this is the actual performance with the acquisition premiums. But we also want to kind of look at the business without the acquisition premiums to say, how is the underlying business doing that I bought if I didn't pay extra to buy it? So I kind of want to see the performance of the actual business and then the performance of the business with my purchase price in it. This is the actual ROIC. This is kind of like the underlying business performance. That's why there's two trees. In this file, there's data on Raytheon, renamed themselves last month RTX, Northrop Grumman, General Dynamics, L3, and Boeing, and Leidos. Who in this class works for any of these companies? Who do you work for? Adam?
Northrop Grumman.
Okay, and Mays?
Northrop Grumman.
You both work for Northrop Grumman?
Yep.
All right, great. So for the teams that you were on, I want you to compare Lockheed Martin against Northrop Grumman. Compare those two trees, analyze those two trees, and tell me about the differences in those two companies. Ignore the rest. Okay. So that's one part of the exercise. Part of the exercise number 2 is this file. Sorry, I closed the wrong one. Called Parker ROIC Benchmarking. I'm an innovation fellow at Duke, and working with Duke, I was working with the CFO of Parker Hannifin. So I told you Parker Hannifin is a supplier, parts manufacturer globally to a lot of the defense and aerospace companies are in the other one, but other companies as well. Valves, high-tech tools, etc. Doesn't matter. This is Parker's data for the last 5 years. These are their peers. Same concept. Top of the chart with goodwill, recalculated without goodwill. These are their competitors: Caterpillar, Illinois Tool Works, Moog, Emerson Electric, Johnson Controls, Rockwell Automation. And again, all public data. Don't worry about the branding. Okay, so the other groups are going to be working simultaneously. Parker versus, do you guys want to do CAT, Illinois Tool Works, Emerson, Johnson Controls, Rockwell? Anybody sound interesting? One of those companies?
Caterpillar.
All right, Parker against CAT. Tell me, same thing. You teams are going to be working at Parker versus CAT. Okay, so what I'm going to do is I'm going to put you into groups randomly. So let me create the teams. breakout rooms. I'm gonna put you into 4 groups of 6. Assign automatically. So let's see, Maze, you're on a team. And who is the other person that works for Northrop Grumman? Was it Adam?
Yeah, I do.
All right, so I'm gonna move Adam to team 2. Just so that team 1 and team 2 are looking at Lockheed Martin against Northrop Grumman. If you're in room 3 or 4, you're going to be looking at Parker against Cat. I'm going to give you 15 minutes. I want you to walk through the 2 trees as your teams. I'll be in the main room if you want some help. And I'm going to ask when you come back for somebody to walk through each of the trees. Tell me what's going on with those 2 companies over the 5 years, why their ROIC is getting better or worse, and how they're doing against their peers. Okay, this is a preview for your next week's homework assignment. We're going to practice it right now in class. The only difference, you can be writing it up. Okay, so questions about what I'm asking you to do for the next 15 minutes? If you're in room 1 or 2, basically, if you have the 2 Northrop Grumman people on your team, you're doing Northrop Grumman and Lockheed Martin. If the 2 Northrop Grumman people are not on your team, you're doing Parker, Hannafin, and Caterpillar. Right? Other companies are there, but those are the 2 I want you to focus on in the 15 minutes. And then we're going to come back and debrief. See you on the other side. And I'm going to pause the recording. All right, welcome back. Recording is back on. So we had 2 of the rooms that we're looking at Lockheed Martin against Northrop Grumman. So room 1, which had Maz in it, why don't you tell me about Lockheed Martin? Share your screen, walk us through Lockheed Martin.
Okay.
So whoever your spokesperson is.
Okay. For Lockheed Martin, I'm sharing this screen. For
Okay.
Lockheed Martin, the ROIC increased, which is positive for the company. And the main driver of that ROIC is the intangible. We arrived at that by looking at the operating margin and invested capital. The operating margin actually went down, but there's an improvement in the invested capital over sale, which is because that means the Lockheed Martin is investing 40 cents in 2022 versus 44 cents in 2018.
Okay,
And
I can pause you for a second. As you're going through this, please use numbers and go from to. Just
okay,
everyone can follow. There's a lot of information on the screen and not everybody's probably following what you're saying. So just for
okay,
everybody's benefit, this is also important for grading. You must use the froms and the twos. It went from 26,
okay.
26.9 or whatever the number is. So we can follow.
The ROIC went from 30.7% to 31.4%, which
Okay.
is a 2.3% increase.
Great.
That is positive for the company because they are generating more return on their investment. And the main driver of that return on investment increasing by 2.3% is the intangibles that went down by 24%. The intangible going down from 26.5 cents per sale to 20.1 cents per sale. That's a reduction of 24%. That means they are investing 20 cents in 2022 versus 26 cents in 2018.
Okay.
And
before
if
get
we
to the
break,
second level, sorry to interrupt again. Make sure everybody goes through the first level separately. Like go through the first level, 3 drivers, then go down a level, as opposed to just jumping right to the second level. It'll just be helpful for both me to follow you as well as kind of a consistency of approach. So tell me about the first level drivers first. Why did it go from 26.5 to 26.9? Why did it virtually stay unchanged?
which one are you talking about?
Tax rate, operating margin, invested capital to sales. What happened there? Tell me the story of just those three.
Cash sales, cash rate, invested capital, and operating margin.
Those
Okay,
three.
the
Yeah.
cash rate the cash tax rate increased. That means the company is paying more tax than they were paying in 2018. It increased from 13.6 to 14.2. That's
Okay.
a 4.6% increase.
Which helped or hurt ROIC?
It hurt ROIC.
That hurt it. Okay.
Yeah.
Now, what about the next two drivers? What happened in the
The-
pre-tax?
To the pre-tax ROIC, it went up from 30.7 to 31.4. That helped the company.
All right. Why did it go up? Was it the margin or was it the productivity?
It was the productivity.
The margin, what happened to the margin?
The margin went down by 7.3%.
So that's hurting the pre-tax ROIC.
Yes.
So
And
all the improvement was in the invested capital to sales going down from 44 to 40.
Correct.
Yeah, that's what I need everybody to just, when I say walk through the first level, always start with those three. Okay, because that tells your story at a high level.
Okay.
Then click down. All right, so what she did, which is good at the beginning, you made the connection. Why did the invested capital to sales go down by 4 cents? What was the driver there?
The driver is
Second
the
level driver.
intangible.
That was the intangibles that you started with.
Yes.
Say she skipped the first level and made the connection. It was correct connection. But I'm saying just go through the first level, then click down to the second level. It'll help
Okay.
everybody, including me, when I'm grading you, and you for your understanding of it.
Okay.
There's a lot going on right now with these statements.
Okay.
Again, the productivity really was the lower intangibles.
Yeah.
Now, they did get a little bit worse PP&E. They are spending more PP&E, 11 to 14 cents. So that
Yes.
will change.
That hurt the company.
Working capital didn't change, PP&E worsened, but all the benefit was the intangibles offsetting the higher PP&E to lower invested capital sales.
Correct.
Okay. The operating margin went down. Why?
The operating margin went down mostly because of gross margin that went down by 6.4%, as well as the depreciation. Depreciation is flat, relatively flat. It's mostly the gross margin.
All right. So one of the reasons I choose Lockheed Martin, and this is actually hard to explain, is because their financials are weird. They don't follow accounting rules publicly. Like every other company in the defense and aerospace industry, and for that matter, almost every other industry, breaks out cost of goods sold and SG&A. You're supposed to. It's accounting rules. It's FASB. It's GAAP. Lockheed Martin chooses not to do that. They combine cost of goods sold and SG&A. They just have one line item on their income statement called operating expenses. That's why their SG&A is practically zero, because they don't break it out. So it is harder to do Lockheed Martin and compare them to other companies because they don't really have a gross margin and they don't have an SG&A. They lump them together. So I intentionally chose that because I wanted to show you an exception, because sometimes you'll run into companies like this and there's nothing you can do. Like as an outsider, it's just what their accountants are letting them do, and there's nothing we can do about it. So this one area is not as comparable. And in that case, we would just compare them on the operating margins. Sounds a little bit of a curveball with Lockheed Martin. All right, thank you for kicking us off. You actually connected the right dots otherwise. Thank you. How about room 2? That was with Adam's team. Talk to us about your company. Talk to us about GD. Or Northrop Grumman. Is Northrop Grumman? Or General Dynamics? Who did you guys look at?
Yeah, it's Northrop Grumman.
Northrop Grumman. So you guys talk to me through Northrop Grumman.
All right. So we had Northrop Grumman, and their end of year ROIC decreased over the 5 years from 12.2% to 10.8%, which was roughly an 11% decrease. The main contributors were the cash tax rate changed by 17.5% over the 5 years, with a large bump in 2021. The operating margin and invested capital also decreased over those 5 years, with the main contributors being depreciation was extremely large, and the change in operating working capital of negative 223% over the 5 years. And that could be contributed to large investments in inventory and things like that during COVID. Other large swings were large changes in PP&E and intangibles. From PP&E from 2018 to 2022, there was a change of 36.9%, and intangibles by negative 26.6%. But overall, it appears that the cash tax rate was a large contributor to the negative ROIC for Northrop Grumman. But things that helped them was depreciation. I think that helped them significantly dampen that. But it doesn't look as pretty as Lockheed Martin.
Well, the operating margin also did go down. It went from 12.6 to 9.8. So they are making less in every sale.
Mm-hmm.
That hurt their pre-tax ROIC as well. So it's almost like two things are driving their after-tax ROIC down. They're paying more in taxes and they're making less on every sale.
And it looks like they also spent more to get those sales. With their SG&A went up from 0.1 to 0.106,
Yeah.
almost a 6% increase.
So a slightly lower gross margin, 25 to 24, and a slightly higher SG&A from 10 to 11. Rounding off. 10 to 10.6. That hurt their operating margin, which hurt their pre-tax ROIC. Is everybody seeing that? Is everybody able to connect those dots? Questions about any of that? So room one, room two, who do you like? Over the last 5 years, was Lockheed Martin doing better or is Northrop Grumman doing better? Just look.
I'm biased.
Lockheed Martin, right?
It was Lockheed Martin, right?
Yeah, higher IRC.
Well, the ROICs here are like 10 to 12. What was Lockheed Martin's?
1.5.
26.5 to 27. So Lockheed Martin had a much higher ROIC every year over 5 years. Why? What's the biggest difference between these two companies?
The intangibles, right?
Start with the first level drivers. Was it the tax rate? Was it the operating margin? Or was it the invested capital to sales? What's the biggest difference between these two companies?
The tax rate.
I don't think so. 14 to 16% at Northrop Grumman. What's it at Lockheed Martin? 14%. I don't think the tax rate's what's driving that ROIC to be twice as high at Lockheed Martin.
The operating margin is far less of a decrease at Lockheed Martin than it is at Northrop.
I know it's less of a decrease, but it's still around 10 cents versus in 2022, it's 10 cents. What is it in Lockheed Martin?
It was like 7.3.
13. So Lockheed Martin makes more per dollar of sales. But I think the real differentiator, look at that invested capital sales. How much in 2022 is Lockheed spending on invested capital?
40 cents.
And how much is?
Almost half,
70.
almost half.
Yeah.
More
See, the real, and if you played around and looked at the other numbers that I gave you here, what you'll notice is Lockheed Martin's competitive advantage is they tend to use less capital to generate sales than many of their peers. Yeah, they might have a little bit better margin, not always, but they're really good at not using a lot of capital. They're efficient. They're really efficient at what they do. And that translates into much higher ROICs. Does that make sense to everybody? You see that in the first level drivers. And part of it is the intangibles. They didn't spend as much in acquisitions as everybody else did. You could also look at it without the acquisitions, and then they start to look a lot closer. All right, room 3. Let's switch to the other team. Somebody in room 3, talk to us about Parker Hannafin. And room 4, you're going to be doing CAT, just to prepare yourselves. So room
Everybody see my screen?
Yeah. Talk to us about Parker.
All right, so we'll start with the with goodwill section. So their end of year ROIC went from 10.6% to 11.1%, which is a 5.2% increase. On the second level, we can see that their pre-tax ROIC was negative. It went down to negative 19.5% from 17% to 13.7%. It's kind of clear here. You can see a disparity between their end of year ROI and their pre-tax ROIC, and that can be explained by their cash tax rate decreasing by 51% from 37.7% to 18.5%. If we get into their operating margin increased by 33.4% from 0.135 to 0.180. So how they did this was through their gross margin increasing by 12.9%. Their SG&A went down, which is good, to negative 10.5%. And their depreciation also increased by 10.6%, which is good. So that's kind of explaining how their operating margin increased like that. If we move into their invested capital over sales, this increased, and we can look at the operating working capital increasing exponentially by 254.8%. Their property, plant, and equipment over sales increased by 9.6%, and their intangibles to sales increased by 30.4%. So if we compare this to their ROIC without goodwill, the invested capital over sales increased by 135.4% right down here. So this kind of shows that they were putting a lot more money into the business without intangibles. You can see right here with their operating working capital over sales. So the end of year ROIC truly decreased by 25.9% without their intangibles in play. This is kind of masking a return on the true in-house operating activities, as far as, as I can tell, or as that's kind of the picture that I'm getting from this. Yeah, I'll stop there.
Good job. Anybody in the team want to add to that? Or add commentary, questions? So again, headline ROIC, looking at the top tree, got a little better. Mainly because, as he said, the tax rate went down and they got a lot higher operating margin, particularly because their gross margin went up. But that was more than offset on a pre-tax basis by all the money they're spending. They're spending huge amounts of money to generate higher margins. Spending a lot more money on working capital. They're spending a lot more money on intangibles. So what practically happened is they bought a higher margin business. And they bought it in 2020. So they fundamentally changed their business for more margin by going out and buying another company that was a much higher margin company, including in their business. Improve their margins, but they spent a lot of money to do it. So net, are they really better off? Because they spent so much to get the higher margins, they're kind of offsetting each other, and their ROIC actually went down. Questions about Parker? All right, good job, Parker team. Final team, Cat. Tell me what's going on with Cat.
All right. Can you see my screen?
Your menu on the left seems to be kind of overlaying. There it is. Okay, go ahead.
Good. So we kind of made some notes here. So comparatively, you know, Caterpillar to Parker, I'd say Caterpillar is doing a little bit better. Parker, like we just looked at, just a little bit worse. But Caterpillar is just gradually getting worse. So starting off with their tax rate. Their tax rate actually went 2% like up a little bit, which is interesting. And then, you know, as we look at the operating margin, they decreased slightly, about 12%. But then the investment capital also decreased slightly. And so it kind of offsets a little bit. We look at the ROIC, they go from 22.5 to 22.1. So again, less than like a 2% decrease. So again, another gradually getting a little bit worse. Looking at what caused the operating margin, if we look at the gross margin, it goes down 8%. So again, gradual decrease. SG&A expenses go up a little bit of 1.6%, and then offset a little bit by smaller depreciation at 0.037 cents compared to 0.51. So that's what kind of leads to the operating margin. And then looking at the invested capital, and again, you can kind of see with the red and the green, red being drivers of a bad performance versus green driving the good performance. So like with operating working capital, it goes up 7%, while the investment on property, plant, and equipment goes down. So that's what's driving the invested capital lower value here. And then, you know, for intangibles also goes down, contributing to that slightly reduction. So again, gradually getting worse, but not as bad as Parker. I think Caterpillar is a construction equipment manufacturer, specifically more so in construction. Parker is more so serves like a broader industries. So perhaps they were more affected by the supply chain disruptions through the pandemic, rising material costs, and maybe labor shortages. More so than Caterpillar. Caterpillar is also a bigger company. So maybe that helped give them some cushion. And then again, ROIC without goodwill follows pretty similar numbers. But is there anything else I should cover or the team wants to cover?
I'll tell you, I actually like the fact that you were highlighting in green and red and the arrows, because I think it helps, just if I were doing this early on, to understand the directionality. Like I look at these trees all the time. So for me, I'm comfortable with them. I kind of know how everything ties together. If you're just looking at this for the first time, I think doing what this team did here might help you as you start doing your next homework assignment. So feel free to add arrows or whatever. And then when you do your write-up, make sure you use numbers, do the from twos, and connect the dots. First level, second level. All right, questions about ROIC trees?
Professor, just for that last one, I was curious, with their, I was trying to figure out, did it seem like they were maybe selling off some pieces of their business?
Where were you, because the goodwill went down?
Their intangibles went down by 30.
Went down? Yeah. Well, potentially. And I say potentially because, and this is why it's sometimes helpful to look at the actual numbers. Why would intangibles go down? Why does goodwill go down? Which gets back to the accounting. Does anybody know?
Could have been a write-off maybe, but.
So it could be a write-off. So they may not be selling the business. They could have written it off. They could have impaired it.
Okay.
So that's one reason it could go down. So, but it could be they're exiting and selling, or it could be they're impairing. That's why we'd want to look at the cash flows. There's another reason though, which is everything in there is related to revenue. let's say that they had terrible sales in the pandemic, then as a percentage of revenue, things go up. So spending as a percentage of revenue is higher because my revenue is lower. And if I have more sales coming out of the pandemic, then those numbers look better, even if I didn't do anything to that business. So it could just be the cyclicality of the nature of Cat's business.
Okay, thank you.
So an ROIC tree doesn't give you all the answers, but at least it starts the conversation. But at least it starts giving you an understanding what some of the operating items that are going on and drivers of the operating items for any company. And this is going to be important because in 2 weeks, when we start forecasting and coming up with a forecast, these are the things that we're going to forecast. We're going to forecast working capital. We're going to forecast PP&E. We're going to forecast margins, right? To forecast cash flows. So understanding the past doesn't guarantee the future, but will help us when we start thinking about like, what is a reasonable margin for a company going forward? What is a reasonable SG&A level? What is a reasonable EBITDA margin? What is a reasonable level of invested capital on a go-forward basis? So we use the past to help guide some of those forecasts. Any questions about what we just did? And again, you have some other companies if you want to do some additional practice on your own.
One other question. Did you mention that as you go kind of up the tree, it's more income statement related, and then down the tree was balance sheet, or was that, did I miss that?
Well, the short version, let me pull up CAT, since you guys were just talking about it. So ROIC combined, tax rate split out, pre-tax, operating margin, which is driven by the income statement, invested capital sales, which is driven by the balance sheet. So this side of the drivers is the income statement. This side of the drivers is the balance sheet. Income statement and balance sheet equals ROIC. So both statements are relevant to your ROIC. And by the way, related to cash flow, because change in here is investment in the free cash flow equation. So the change in the investment drives the gross investment. This drives your gross cash flow. This is your proxy for your free cash flow after tax. So these statements are actually related to the cash flow statement.
Thank you.
Other questions? All right. Back to our lecture note. In the lecture note, and I'll go back to Starbucks. This was the Starbucks ROIC tree. We just went through ROIC trees. The other statement is the rearranged CFI. This is the rearranged cash flow in Modigliani-Miller format for Starbucks for the last 5 years. Anytime you do a cash flow analysis, there are 4 parts of the cash flow because we rearranged everything to fit to Modigliani-Miller. The first part is called the operating cash flow. That's the free cash flow, gross cash flow minus gross investment. The second part is the non-operating cash flow. Non-operating assets and excess cash, usually the biggest drivers of non-operating cash flow and the income we make on that. The debt cash flow is the change in debt and the interest paid to the debt holders. And the equity cash flow is any change in equity in the dividends or share repurchases to those equity cash flow holders. So these are the 4 sections of CFI in our rearranged statements. So same concept. If we were to do the CFI on a real company, that would be Starbucks. So here is Starbucks CFI. 5 historical years. And then what I just did is I summed a total, which is the sum of the 5 years. So it's not an average, it's a sum of the 5 years. Okay, so just 5 years worth of CFI. When you do a CFI analysis, we start with the operating free cash flow right here, this row. This is the important row, and I'll start with the total. Over 5 years, this 5-year period, they generated $3.2 billion worth of free cash flow. That's real. Okay. Now, that number is important because if it's positive number, which in this case it is, then the analysis is what did they do with the $3 billion? How did they spend this $3 billion of free cash flow? If this was a negative number, then the question would be, where did the funding come from to fund the negative free cash flow? Okay, so free cash flow is where you start, right? Why did they generate $3 billion of free cash flow? They generated almost $21 billion of cash from the income statement, 20,990 million. They reinvested 15.9 billion of gross investment back into their balance sheet for operating activities. 16.9 billion of capital expenditures, negative 960 million taken out of working capital. Total 15.9 billion reinvested, 20.99 billion of gross cash flow, 15.9 billion of reinvestment, 5 billion before acquisitions. They spent 1.791 billion on acquisition premiums. That's goodwill. And they ended up with 3.2 billion of free cash flow. That was Starbucks over 5 years. The average reinvestment rate was 76%. Gross investment divided by gross cash flow is the reinvestment rate. So of their cash profit, they put 76% back in, which means what's their payout rate theoretically? What is Starbucks' theoretical payout rate?
Like 24%.
24% on average over the 5 years. Now, some years they reinvested more than others. Their big reinvestment was in 2020, where they put in 400% of cash flow. So they were obviously trying to open up a bunch of stores. Okay. Now, here's another little advanced tip. This is the ratio of CapEx to depreciation. Okay. CapEx, known as capital expenditures, and then depreciation, which is the amount of your PP&E that's being worn out every year. Typically, we do it as a straight line. Here's an assumption we make in finance. You have to invest your depreciation to stay steady state. If depreciation is what it's wearing out every year, you have to put back in depreciation if you're going to maintain what you got. Okay. That's just an assumption we make in finance. So if you're spending more than your depreciation, why would you do it? If spending depreciation equals steady state, why would you spend more than depreciation?
If you're trying to grow.
What was Starbucks' CapEx and depreciation rate over the 5 years? What's their ratio of CapEx and depreciation?
47%.
Why would they put in $2.50 of investment for every dollar of depreciation?
They bought a bunch of stores in 2020.
They're trying to grow. So here's a little forecasting tip. When you see a big CapEx to depreciation ratio, the next year, you would expect to see sales growth. In 2020, Starbucks spent a huge amount of CapEx relative to depreciation. In 2021, it went from 600% to 100%. Now at 115%, I'm kind of close to my depreciation. Why might Starbucks not be wanting to grow so much in 2021? What are they really telling you about 2022? Do they expect a lot of growth in 2022 based on this number?
No.
Why might they not expect a lot of growth in 2022?
Because they're not opening new stores.
Why aren't they opening new stores?
COVID.
Probably
COVID.
owning in and
It's COVID. They were signaling to the market that they weren't going to be opening a lot of new stores in 2022, probably because in the middle of 2021, things started getting shut down. So they pulled the plug on a lot of their expansion. And you could see it in the slowdown in their capital expenditures. Because the previous years, they were spending a lot to grow, and then they basically slowed it way down. A lot of companies did. Can't blame them for doing it, but I'm telling you, there's a signaling effect. 1 year, typically, when you see companies make a big bet on CapEx. Why are they betting on CapEx? They expect to grow. In fact, the opposite is true. If they don't invest their depreciation, if they invest a whole lot less than depreciation, they're not expecting any growth. And so in a way, you can use this as a signaling effect when you start looking at least short term, what companies are saying about their growth rate. All right, $3.2 billion of free cash flow. They ended up with CFI of 8.5 billion. That means they generated $5 billion of non-operating cash that was then distributed. Where did most of this non-operating cash flow come from? How did they get from 3.2 billion to 8.5 billion? Where did they get the $5 billion from?
Non-operating assets.
They sold $6 billion of cash by selling a bunch of non-operating assets, and they got a $3 billion gain. That's $10 billion. They got $10 billion worth of non-operating cash flow. Why did the payout only go by 5 billion? Where'd the rest of the cash go?
Excess cash.
Did excess cash go up or down?
Oh, down.
No, it went up. They basically put money into savings. They got 3 billion of cash flow from their stores. They got 10 billion of cash flow from non-operating activities, and they put 4 billion in their bank. They basically banked a bunch of cash. They had 8.5 billion to distribute. Now let's look and see what they did with the 8.5 billion. They paid 1.1 billion in interest. You got to pay the debt holders for the debt they had. What does this negative 20 billion mean?
They
What's
took
that?
out more debt.
They took more loans.
They took out $20 billion worth of new debt. Most of it in 2020, probably related to this acquisition. But over 5 years, did they need to borrow $20 billion?
No.
How do you know? I agree with you, but how do you know that they really didn't need to borrow $20 billion?
Because it's
Because
not,
they paid a lot of dividends.
No. How do you know they didn't really need to borrow the 20 billion?
Would it be the cash available to investors?
Yeah, they had
CFI?
8.5 billion to pay out. Why did they borrow 20 billion if they had 8.5 billion to pay out?
Probably
And
rates hit
that's the story.
rock bottom.
Here's the rest of the story. Why would they borrow all this debt if they didn't really need it? Well, they paid out $9 billion worth of dividends, and they bought back $21 billion worth of stock. What's 9 plus 21, rounding off?
Almost 30.
How do you give $30 billion to your shareholders if you only have 8.5 billion of cash flow to pay them? You borrow $20 billion worth of debt. Why did Starbucks borrow $20 billion worth of debt? To buy back $21 billion worth of stock. They basically changed their cap structure. They took advantage, and a lot of companies did this, of all-time low interest rates to issue debt, and they used that debt to buy back stock. Now that's important because my question is that sustainable? If we're forecasting this, can they keep buying back stock at this rate?
no,
What rate can they keep buying back stock? If they repeat these 5 years, what rate can they buy back stock?
Add cash flow available to investors,
Nope. Go up one.
free cash flow.
That's your theoretical payout rate. This is what they can pay the shareholders. That's the dividend and share repurchase from operations that can be distributed. So don't get me wrong. As a shareholder, I like the cash. And as a CEO, I'm paid to drive the share price higher. And by basically increasing the earnings per share by getting rid of a bunch of stock and reducing the number of share count, I drove the stock price higher. So I got a nice little bonus, but I did it not because my operations got better. I did it because the banks lent me a lot of money. And so as an investor, all the stock buyback, yes, I appreciate, but it's one time. This is not sustainable. They can't keep buying back stock at this rate. The banks are going to stop lending them the money. Because if they got $3 billion a year to pay it back, they can't keep borrowing $20 billion to basically keep buying back stock. The math doesn't work out. And so that's another insight you would get by doing what's called a CFI analysis. Questions? What happened at Target? They generated $19 billion worth of free cash flow. $31 billion of gross cash flow, 11.9 billion of gross investment, trivial investment in goodwill, 19 billion of free cash flow, 15 billion of CFI, because they also put $4 billion in the bank. What did they do with their $15 billion? 2.7 billion in interest. They issued $2 billion worth of debt, but they paid to shareholders $15 billion, 6.7 billion in dividends, 9 billion in share repurchase. So they took their CFI and they paid it out. They paid out almost $15-16 billion, but they made 19 billion of free cash flow. This is sustainable. So when I look at Target and I look at the amount of money they're rewarding to shareholders, they can continue to do it based on the free cash flow that they're generating. Starbucks can't. Does everybody see the difference there in looking at these numbers? That is a CFI analysis. These are the 4 sections, and I'm simplifying it by just adding up the 5 years. Obviously, year by year matters. Okay, before I get to your homework assignment, questions about any of this? All right, since you guys are the advanced financial modeling class, here's what I need you to do for your next week homework assignment. I'm going to give you 2 companies. They're actually relatively straightforward. One is Costco, of which you actually have 4 of the 5 years of data here from 2017 through 2021. And I'm going to ask you to do an ROIC tree from 2018 to 2022. So when you have your ROIC tree, it's just one more year, which is the most current year, in addition to these 4. The other company is Walmart, which is not here. And it has 5 years of ROIC, which goes from 2018 to 2022. Okay, so your homework assignment for next week is going to be doing a 5-year ROIC tree analysis of Costco against Walmart. Okay, and 5 years of just free cash flow, stopping here. You won't have to do the rest of the tree or the rest of the statement. You're only doing the first part of the statement through free cash flow. Okay, you're going to basically look at all the numbers and write it up in a paper. Okay, explaining what happened over the 5 years. What happened over the 5 years for the ROIC for the Costco and Walmart? What happened to their free cash flow, summing the 5 years for Costco and Walmart? Just free cash flow. Don't worry about the other 3 parts of the statement. Everyone with me so far? Okay, here's the deal. I am going to give you an income statement and balance sheet for Costco and Walmart in a standardized format. Your homework assignment is to create the trees. Your homework assignment is to create the free cash flow. Going through the standardized income statement and balance sheet, you will need to create the ROIC, operating ROIC, the trees, and the operating free cash flow. I'll give you the raw data. You have to create the trees. And then you got to analyze the tree. You have to create the free cash flow. And then you have to summarize the free cash flow. That is your homework assignment next week. You can choose to work individually. You can choose to work in your pair teams. So what you're going to get, and I got to put the data up. It's going to look something like this. So here's Starbucks as an example. All right. Zoom, share screen. Where is Starbucks? Here's Starbucks. Okay. So what's going to happen is I'm going to give you income statement data. This is Starbucks. You'll have Costco and Walmart from 2017 to 2022 in a standardized income statement format and a standardized balance sheet format. Okay. Don't worry about the forecast. You'll have to create the forecast in 2 weeks. But basically, you're going to take this data and you're going to create that tree. I'm not going to give you the tree. Like my model auto builds the tree. Okay. You have to build the trees. Now, because I'm giving it to you in a standardized format, if I were to give you another company, you could then put the other company's data in the standardized format into your tree, and then Costco could become Pfizer. Okay, but that's going to be very important for the next part of the class, because these statements that you're building from these auto statements, the income statement and balance sheet that create the tree and the free cash flow forecast, are the basis for the valuation models that you're going to build. Okay, and so like I said, because this is the advanced class, advanced modeling, I'm not going to just give you the models. You got to build the models. Okay, and I'll help you build the models. We'll talk about it in class. And if you need help, you can reach out to me throughout the week. But as I said, I'm going to give you a standardized income statement and balance sheet. I need you to forecast the tree, and I need you to forecast just the free cash flow. Don't worry about anything else. Okay, and then analyze it for Costco and Walmart. These are easy to value companies. They don't have a lot of non-operating items. And so it should be easy to pick out. Okay. And I'm not going to give you the 1, 2, 3, 4s. So you got to figure out what's operating. But that's the whole point. To create the tree, you have to create operating items. Pull out the operating items to create the tree. Do it in Excel. So I'll give you these 2 tabs. Create that tab. Use references. So that way, if I give you new data, you can basically have this tree auto built. And I'll give you two sheets of data, one for Costco, one for Walmart. And that is your homework assignment for next week. Questions?
Yeah, you said so. I mean, we'll build these trees, and because the income statement and the balance sheet are kind of standardized formats, we'll be able to just paste new companies in there, and it'll kind of auto-populate the tree for any new company.
Exactly. So it'll be based on this standardized format. So for this semester, I'll give you data in this standardized format. If you were to ever use this model for like another company, you probably would have to figure out how to basically type it in, or feed it from another data source and put it into this format. For the rest of the semester, I'll give you the base data in this format, so it'll make it a little bit easier for you. So you don't have to go like Because I could say, go get the Costco 10K, go get the Walmart 10K and figure this out. I believe that's too much of a burden. So I'm going to give you the data in standardized formats that are the same for both companies. So it'll be easy to create the tree standardized for these two companies. Create the trees, create the cash flows. But this file is going to be very important because once you create these, you see all these other tabs. This is where you're going to create your forecast valuation. You'll be building this over the next several weeks. So these will become your valuation model. Right now, we're just looking at the past. But once we have the past, we'll use it to build the future. So that's where we're going with this. Okay, that is your homework assignment. If you have trouble, as I said, feel free to email me. I'm going to put the data up. It's not going to be up to 10 o'clock at night tonight because I'm going to go get the data in the standardized format to make it easy for you. But sometime tomorrow morning, I'll make an announcement when it's there. And this is what you're turning in by 5 o'clock next Wednesday. And then we'll go over this in class next Wednesday. Okay, again, you can work on it individually, you can work on it as a pair, individual pair, just like you did for your last homework assignment. Questions about any of that conceptually? All right. The other thing I wanted to, in our last few minutes, is go over the other part of week 2 homework, which was NVIDIA. So as part of your other homework assignment, you guys were doing an EIC on NVIDIA. And one of the things that I would have asked you in the E is to talk about their economic sensitivity. Was this industry that NVIDIA is in for semiconductors, was this industry or is this industry economically sensitive? Is it sensitive to changes to the economy?
Very,
I'm sorry?
very.
Yeah. And what data on this screenshot that I gave you suggested that?
The beta.
Which, give me the numbers.
For the industry, it's 1.65 and NVIDIA is even higher at 2.02.
Yeah. So basically, semiconductors go up a lot faster when the market's up and go down a lot faster when the market's down. All right. Did anybody kind of read through the industry analysis? Like what drives semiconductors to be so high beta? What's driving this economic sensitivity? What'd you say in your papers?
The materials that went into it. So you have like raw materials like copper, and those are commodities that fluctuate greatly. And then there's also a lot of consumer sentiment around, you know, all of a sudden there's a new chip and things change, or there's big increases in just, you know, not affording certain things, or also the pandemic having a great impact.
Okay. And two things that you could have done there. So everything you said, I agree with, is you could have said, okay, on the consumer side, semiconductors are driven by the economy. On the business side, they're driven by the economy. But consumer demand is much more up and down. And how do we know that? Why is consumer demand so up and down with the economy?
Discretionary income.
Yeah. So basically, when we have less money, we buy less computers. As a matter of fact, that's what's happening in the semiconductor industry right now. Is that in last year, 2022, it was a boom year because there weren't enough chips to go around. And then overnight in early 2023, people stopped buying computers. Because as economic times got tougher, interest rates spiked, and the Fed was tightening, people slowed down their purchases of computers. You know what? I'm going to make that laptop last an extra year or two. I'm not going to go through the upgrade cycle. And then suddenly there was a glut of semiconductors, and companies like Intel got crushed like a tin can because they were sensitive to consumer sales and people stopped buying PCs. And it wasn't just consumers, it was Apple too. Everyone sold less PCs in the first quarter of this year, and the semiconductor industry took a hit. That's the economic sensitivity playing out right there. Why?
There's also a lot of supply side risk as well in the semiconductor industry. Like there's a huge drought in Taiwan a couple of years ago that lasted a while, and it impacts the ability to clean the substrates.
And that supply demand balance is going to play out, particularly when we get to the five forces, but that also affects economic sensitivity. Why is generally the business side of semiconductors a little less volatile than consumers right now? Still high beta, but you could argue that the companies that are tied more to the business side have a little bit lower betas than some of the ones tied more to the consumer side. Why?
I would say that the businesses are going to buy the computers regardless. They need them to run their business. They have more discretionary income, so to speak.
And what areas of business are still booming even in tougher times right now in the real world?
Data centers.
Yeah, it's the data centers of the cloud. So all that growth in data centers of the cloud has kind of offset what you would see in the supply cycles for the business side. Now, if the data centers actually start getting mature, then you're going to see more volatility there. But right now they're not mature. They're still in high growth modes. And that has lowered the beta on the business side versus the consumer side. But that's a little bit more advanced, but those are just some of the things you'd be talking about for economic sensitivities. All right. Second part of your analysis. Is this industry creating value?
Yes,
Because the ROIC is greater than the WACC.
correct.
Does NVIDIA demonstrate competitive advantage?
No.
Last year, no. Okay, last year, no, because their spread relative to the industry was lower. Now, here's what's interesting. Will NVIDIA demonstrate competitive advantage in 5 years?
Probably not.
Actually, yes. They became one of the $1 trillion babies in the last 3 months. Why?
Because of AI, interest in the artificial intelligence that's powered primarily by NVIDIA and GPUs.
Exactly. So what's happened is NVIDIA, which has been spending heavily on its chips, huge investment. If we did an ROIC tree for NVIDIA, we'd see a big spike in PP&E because they are churning out the AI chips that are critical to the AI cloud. And so their sales are expected to triple to data centers over the next few years. And so their ROIC is going to go up dramatically over time. Now, that's just something when you understand about NVIDIA, and that's why they had such a high valuation. So they don't have competitive advantage now because they're kind of like Starbucks 2 years ago. They're in heavy investment mode, but that's probably going to pay off because they are way ahead when it comes to AI chips. Now, back to five forces. What about the five forces explains the current industry spread? So it's slight positive spread, 16 versus 13. Why do we have a positive spread? What's
Because there's extreme barriers to entry in this industry. So
huge barriers to entry, gigantic capital requirements. You can't just go create a fab. These are cost like $20 billion plus the tech patents. So barriers to entry work in favor. What else? What else worked in favor in 2022? You guys said it a minute ago.
I would even say the power of suppliers is pretty low. So relative to each of these firms, because none of the materials are specialty metals or anything like that. There are some difficulty getting certain silicon and some nitrate, but overall not difficult.
So their suppliers don't have a lot of power over them, but do
Mhm.
they have power over their buyers?
Yes.
They do, because
Yes.
there's only like a handful of firms that can create 2 nanometer wafers. It's like TSMC, Samsung, and Intel.
And are there a lot of substitutes for that?
There's none right now, but there will be.
That's why in the automobile industry, like 2 years ago, you couldn't get like touchscreens in BMWs.
Mhm.
Because there just weren't enough semiconductor chips, and it wasn't like you could just go get any semiconductor chip to put in that car. So they had power over their customers. Power of the buyers is pretty strong. Huge barriers to entry. And there wasn't as much rivalry last year because there was so much demand and not enough supply for the chips because of COVID. Yeah. the tutu.
Yes, could we also say that because they are investing heavily in research and development, they are able to price higher and that results in the
I think,
power of buyers being low?
well, I think that's the point. That high level of spending further drives a barrier to entry, which tends to protect the margins for the industry because they don't have a lot of substitutes. They kind of relate to each other. And that tends to give a little less rivalry amongst the semiconductors because many of them are specialized for the types of chips that they sell. And that has benefited this industry through COVID in particular, when supply chains caused supply demand imbalances because there was a big spike in chip demand and there wasn't enough supply of the chips to go around. Is that going to be the same in 5 years? Are we still going to see high barriers to entry?
Yes. Yes,
Are we still-
because the research and development, they are getting patents and an average life of a patent is like 7 to 10 years.
So will the patents matter as much in 5 years? Will there be as much competition? As I said, they're all building fabs. Is that going to change the supply demand balance where the demand and supply are more in balance? Because that's what happened very quickly in the chip industry for computers. Because suddenly we went from not enough chips to go around to too many chips to go around in 6 months. And that's why computer demand fell off the table. And suddenly they got all these chips that they can't sell to anybody and they're having to cut their price. So there's a couple of different ways you could answer this 5-year question. And you could both be right. Meaning you could argue that the situation stays kind of like it is today and the barriers play out. And this is a high profit industry. You could also argue that some of these things are changing and that the profitability of the industry is going down. But that's the key point I want you to relate to, which is what scenario, what point of view do you have? Can you kind of tell the story of how it will play out with the spreads? Because where this is going to come into play beyond understanding what's happening to an industry is that when we start to forecast, like if we're forecasting NVIDIA or Qualcomm or any of these companies, then what we're going to have to do is we're going to figure out, all right, is this industry getting better or worse? What the kind of growth rate are we getting at the industry? Are their margins going to be under pressure because the industry is getting worse? Are they going to maintain their margins in 5 years because the industry is going to stay good? Like that's going to have a big difference in valuation when we forecast. So we'll eventually tie the conversation you did for this EIC equation to the forecast that you start to put together for the companies and the industries that we're going to do the valuations on. That's why this homework assignment was kind of an important process assignment. And the point about the future is I don't have the same view of the future that anybody else does. It's the future. I can't tell you what's going to definitely happen in 5 years. But I want you to understand the process of how these things change and what would cause something to change in 5 years. That's the whole point of the EIC assignment. Okay. And so really, that's what we'll continue to talk about and outline as we go through all of these valuations and models that we do. Even the ROIC tree. Like, why did CAT's ROIC tree change like it did? Why was it all over the place? Well, they're very sensitive to changes in the economy. So as you went through COVID, people weren't buying construction equipment at CAT when we were in the middle of COVID because they weren't building roads and bridges and governments were cutting back on all their spending. They're high beta stock. And so therefore, you're going to see big swings in CAT's performance year by year by year. Where defense and aerospace stock is very low beta stock because the government buys defense stuff no matter what the economy is doing. And they sign these very long-term agreements with Northrop Grumman's and the General Dynamics and the Lockheed Martins of the world that don't change year by year with the budgetary season. So they're kind of locked into their sales for long periods of time in the defense industry. Well, that will play out in very consistent numbers for a company like Lockheed Martin versus inconsistent numbers for a company like CAT or even a Parker Hannifin. They're much more economically sensitive. That's why we do this analysis, and this is how it would play out. Make sense? Questions about that? All right, I'll try to have the grades in by this weekend for these first 2 assignments. If you have questions about anything, please feel free to email me. Look for the data to do homework for next week, tomorrow morning, and I'll make an announcement as soon as it's there. It'll be at Costco and Walmart. You can use the ROIC template to help guide this so that when you do Costco's ROIC, you know what 4 of the 5 years should look like. match those numbers. So it'll help you figure out that I get the right operating items together when I built my tree. That'll help with the start. Just looking in the chat before we close out. See, somebody made some stuff there. Any other questions or comments? All right, have a good night. Have a good week. See you guys next week.
Thank you.
Thank you.
Thank you.
Recorded. I'll post. it.
Thank you.